basically priced for the Fed to be hitting their targets all the way into perpetuity.
With a 3.4% unemployment rate, you just don't get a recession.
It's remarkable that the Fed has tightened as much as they have, and you don't see a labor market that is certainly not shedding labor.
The benefits of the decline in inflation, we're now at the bumpy path, and the question is, are we plateauing?
When investors finally do start to look across the valley, the turn will be very, very quick.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Closing out the trading week, live from New York City this morning. Good morning to you all. Alongside Tom Keene, I'm Jonathan Ferro. Lisa's going to be back on Monday. This is Bloomberg Surveillance. Threatening to come back on Monday. Right. Is she going skiing again?
I have no idea. She's probably on some beach somewhere, and we're not.
I thought she goes skiing in the winter, Tom.
I think it's an audible. I think she called an audible this week. She has a jet. Francine was going to take the surveillance Gulfstream, and I think Lisa has it.
I guess we'll find out Monday morning. Yeah, futures look like this right now on the S&P. We're down about 0.6%. Some important economic data coming out at 8:30. Another read on inflation in the United States of America, the so-called PCE. Get some Fed speak as well from three well-known hawks on the FOMC, Mester, Bullard. You'll hear from Waller as well.
Mester moved the market last time. Let's
talking about 50, compelled to hike interest rates 50 basis points.
They're all different, and let me make clear, she is prodigious in mathematics. And, you know, we're going to talk to Sebastian here about the epsilon out there. The epsilon is a systemic noise that's out there. Mester's expert on that. Expert. There's a lot of noise out there. That's been the theme this week.
That's the theme of the last couple of months. How much noise is in the economic data from January? How much signal is there? And if you get a drip feed of better data in the month of February as well, people will shift their view on that. They'll start to believe that the January data had more signal than noise.
Here's the polarity. I mean, you've got Alarian later today for like 3 or 4 minutes.
In the studio.
You know, he's in the studio?
In the studio for an hour.
Do I get to speak to him, or you know, am I held away by your entourage?
Why don't you drop by?
I'll drop by.
Skip radio. Come onto the show with us and have a chat.
Yeah, have a chat.
That'd be nice.
Aaron Rodgers, the New York Jets. I mean, that's where you have to start.
We'll make that work.
But you look at what Mohammed's saying with Ken Rogoff, and then you dovetail it with what we heard from Ed Hyman and Ed Yardeni, and my God, no wonder we have this cacophony of opinion.
Well, look at the move we've had in the bond market as well. 5 weeks of a 2-year yield climbing, breaching 470 again, getting closer to 4%. On a 10-year maturity as well, Tom. That's the argument at the moment. I forget who said it earlier this week, but essentially, the Fed's telling you can get 5% on a 6-month T-bill. Why would you go anywhere else?
Yeah, I think that's a short-term view, but then you got to go out further. I mean, you've got if you got a 6-month T-bill in 6 months, you have to make a decision. That's the key.
That's the reinvestment risk.
This is this is re-hedge. At New York University, a mental block right now. There's a guy who's expert on this, on the mathematics. 6 months out, you got to make a new decision. Yep. You don't have to do that with a 10-year piece.
So the question is, do you believe, and I asked this earlier this week, is this a once-in-a-generation opportunity to lock in yield over a long time? Or is it a new generation of high yields where you don't have to worry about that reinvestment risk?
This is critical. And with Sebastian Page coming up, folks, this is why Global Wall Street needs to lean forward on radio and TV. What do we do now with our traditional portfolio theory, because we're back to a normal rate structure? That's the heart of the matter.
Let's get to that conversation right now. Sebastian Page joins us, Head of Global Multi-Asset and Chief Investment Officer at T. Rowe Price. Seb, always great to catch up with you, sir. You've got a phrase in your research. It says aggressive defense. What's aggressive defense?
Yeah, another way of thinking about it is we play both offense and defense at the same time. The bearish narrative is so strong. You were talking about it earlier on the show. The gloom and doom is really strong right now. The yield curve's inverted by 81 basis points. PMIs are dropping like a rock. The LEIs are flashing red, the leading indicators. Our models are showing a possible drop in house prices of 7 to 10% this year. We've yet to feel the lagged effect of 475 basis points of Fed hikes. I could go on, but markets look expensive. Earnings expectations look high. So you have this whole bearish narrative. I call it the bearish truck, and it's coming. And we are underweight stocks. That's the defense part. We do hold a cash buffer. We're neutral on bonds because we think bonds could reassert themselves as diversifiers in a growth shock. Where the aggressive part comes in, or the offense part, is being long S&P 600, quality small caps, which are as cheap as they were back during the great financial crisis,
Right.
and also long high yield at 9% yield. So this is the offense part.
Sebastian Page, I want to go to your spectacular book. And folks, this is one of the great books to read on asset allocation. It is zero BS. Trust me, there's a lot of books out here that are hot air. Not Sebastian Page. It's Beyond Diversification. And in it, Sebastian, you absolutely nail how people feel right now, where you say, look, we're beyond, something about horoscopes. We're literally back to astrology within what we're doing. If we have a time where we're looking at horoscopes, do I do less diversification and concentrate in my beliefs, or do I over-diversify, or what Peter Lynch at a small mutual fund shop up in Boston, Lynch said, diversification? Which way do you go?
You know, Tom, I just presented at the CFA Institute, and I said the macro data is wacky. And that's a technical term, but if you travel back in time with your Bloomberg terminal and you go to what the Fed fund futures were saying a year ago, they were saying that by now we would be at 1.8%. We're at 4.75%. Yet, no economist a year ago would have told you that there is a lag between Fed hikes and unemployment, but that after 475 basis points of hikes, we would be in a situation where we're at a 50-year low in unemployment, creating 500,000 jobs. So it is wacky data, and it calls for diversification. Sorry, Tom, go ahead.
It's okay, Sebastian. I'm just good at interrupting. That's my job. But, Sebastian, I look at what you just said, and my only answer is I can hang my hat on free cash flow. How many companies in the S&P 500 have T. Rowe Price quality free cash flow?
You know, fundamentals are reasserting themselves, I think, from here on for the rest of the year. That's my view. We've had a short covering type of rally year to date. Even cryptocurrencies rallied. I think we're in a situation where, going back to diversification, now's not the time to be a hero. I think you want to have quality investments, quality stocks. You want to have a fair amount of bonds. The yields have come up. You rethink the 60-40. You know, here's the thing that's happening right now is that investors are not only trying to navigate the next 12 months, but because we're at a critical time in capital markets history, investors are rethinking their strategic asset allocation and the role of bonds and the role of treasuries in the 60-40. And to modernize that, one thing you can do is take about 10% of your bond portfolio and allocate it to carefully selected alternatives and look for direct tail risk hedging in the equity portion of your portfolio to make up for interest rate volatility. So this is a very interesting time to be an asset allocator, where not only you need to navigate this transition through a different kind of diversification, go back to cash flows, Tom, to your question, I agree with that, but also rethink your strategic asset allocation.
Sebastian, can I just finish on a note that I got from Torsten Slog of Apollo? A theme for us this week, and I know you watched the program, you listened to it, so thank you for that. I'm sure you might have heard this. We talked about the Fed being data dependent, but questioned how dependable the data might be. Torsten Slog of Apollo said this just moments ago. Response rates to both labour market surveys and inflation surveys continue to decline. The economic data is becoming more unreliable, causing more volatility in incoming data and hence more volatility in markets. Sebastian, what would you say back to that?
I would agree with that. And the big question is, we've had a few good prints. Retail sales 3% in January. That's pretty good, and it was way above expectation. The labor market is just remarkably resilient, and if you're an optimist, you can say this is good for the consumer, and real wages are rising. So there's these potential, I hesitate to call them green shoots, but there are a few good data points that have come out. We discussed this in our asset allocation committee, and I got to say, last year we had complete consensus to be underweight stocks all year. Now we're starting to have a debate, and the outcome of that debate in our discussion last week was these data points, it's a trap. So I'd be on Torsten's side. It's a trap because the bearish train is coming and all the indicators are flashing red.
So you think it's a bit of a head fake, this whole no landing story we're hearing so much of?
I think so. At the same time, I don't think we're in for a hard landing. And I look at asset classes that are pricing in a hard landing, which is where we can play offense in the portfolio. If we get anything but a hard landing, to me, the quality small caps are really, really priced to outperform. And by the way, this is counterintuitive, but those quality small caps have been out earnings the large cap part of the market. So that's an interesting part where you can play. I'm not fully gloom and doom and an uber bear. I'm not as bearish as Lisa most of the time, if you will. But ultimately, I think you got to be careful. Have the cash buffer you earn on that cash, and then position for some offensive positions, for some positions where you play offense.
Can you imagine investment committees everywhere around the country? T. Rowe Price being one. They sit around the table and they're like, "We're not as bearish as Lisa.
Yeah.
We're not as bearish as that, but we are playing aggressive defense."
CFA level 3 has a whole thing in Schweezer, which is the way you test in March to flunk the exam. And like book 3 of Schweezer, buried I think it's the second section, is the Bramo effect.
Sebastian Page of T. Rowe Price. Seb, this was brilliant. Thank you, sir. Lisa's going to have her own comeback on Monday.
She is.
When she gets back.
She is.
Steve Englander talked about that. Standard Chartered, he sat around the table with us, Tom, in the last week, and he talked about maybe the data being unreliable. Not the first time we've heard it. I think we put out a story on it in the last couple of weeks about some of the surveys and inflation surveys. The response rates just continue to decline.
I go back to, we're coming out of a medical event, and as Blanchard phrases it, and others as well, the Biden stimulus, and it's a global stimulus, frankly, and that's where we are. I thought your questions there with Sebastian were great, and I know what you're doing. You're just listening to him, getting ready for the Farrow report. Folks, this is really important. You'll see this March 31 coming up here. John, I know, is going in with his team into study here over the weekend. They do, they do little things down some bar in Soho. The Farrow report is looking at the 274 days of 2023.
Yeah, we don't do 365.
You and I know the year ahead reports on 12/31 are useless.
It's brutal.
Absolutely useless.
It's much more difficult to make that year out call in year 3 of pandemic economics.
And I'm old enough to remember, on this day of the death of Tom Lee, where we used to make 3-year statements. We believe that in 2026. I mean, we used to say that, John.
Can we talk about Tom Lee a little bit later this hour, Tom?
Yeah.
I'd love to reflect on that.
Yes.
That Snapple deal from 92. What a phenomenal man. What a great thinker.
Yes, he was original. He was way out. I think some of the reporting has been not off, but I think he was a very special guy. We'll talk about it.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and other G7 nations are marking the 1-year anniversary of Russia's invasion of Ukraine by unveiling new sanctions. The measures will single out Russia's defense, energy and metal industries, financial institutions, and more than 200 people. There will also be more pressure on third countries to choose between the U.S. and Russia. Meanwhile, China is calling for a ceasefire between Russia and Ukraine in a proposal for ending the war. But the plan has little chance of winning broad support. Several of China's measures would offer clear benefits to Russia's President Vladimir Putin, including a call to freeze Russian troops in place on Ukrainian soil. The U.S. and South Korea are planning for a potential nuclear attack by North Korea. A so-called tabletop exercise was held in Washington, focused on hypothetical scenarios of North Korea's use of nuclear weapons. North Korea has been building up its capability to deliver an atomic strike. It's a setback for Merck's pill to treat COVID-19. A European Union committee has recommended against the use of the treatment in adults. Merck says it and partner Ridgeback Biotherapeutics will appeal that decision. And the billionaire private equity pioneer Thomas H. Lee has died. Lee ran his Boston-based firm from 1974 until 2006, when it had $12 billion to invest after producing triple-digit returns. I'm Lisa Mateo. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
One year on, from the start of his brutal war, Putin has failed to achieve a single one of his strategic goals. Instead of dividing the European Union, he finds us united and determined to stand by Ukraine for as long as it takes.
1 year on, that was Ursula von der Leyen, the European Commission president. We'll be talking about 1 year since the start of this war, the invasion by Russia's Vladimir Putin into Ukraine with Anne-Marie and Maria in just a moment. I want to whip through the price action for you this morning. Good morning as we close out the trading week. Equity futures negative again by 0.6%. Just about snapped the losing streak in yesterday's session. 4-day losing streak broken with a marginal day of gains, and now we're losing again on the equity market, heading for a third straight week of losses. Yields a little bit higher by 2 or 3 basis points. Your 10-year 390.62. Tom, going into a data point a little bit later this morning, about an hour and 13 minutes from now, we get the PCE read on U.S. inflation.
If you go away for a week, do you come back? Has anything changed? The answer is no. Maybe yields will come up a little, but seriously, folks, we've got economic data here in an hour and 15 minutes. Van der Leyen, I want to make a point here that Europe got lucky at the right time. I know nothing about Brussels politics, but this is someone who was steeled in German military knowledge. I think most Americans don't understand whence she came. And van der Leyen had a lot to do with the modern German military.
And German military
makes a difference.
Has been under the spotlight in a big way the last 12 months.
So I think that's been of benefit. Right now, we're going to do this, and we'll go again to Maria Tadeo with that knowledge on Europe. Anne-Marie Horton with us in London, traveling with the president on her way back home. Rumor has it Anne-Marie will be with us Monday. We'll see if that happens. Maria Tadeo, always on the job in Kyiv this morning, this 1-year anniversary. Maria, what does Brussels want? What does van der Leyen want? Not so much from President Biden, but what do they want from their fractious nations?
Von der Leyen, by the way, Tom, which to me was very striking when you asked people in Kyiv, in Ukraine, who do you like, who do you know from the European Union, just to pick up the name recognition. Of course, the first thing they say, funnily enough, is Boris Johnson. I'm not sure how he'd feel about being associated with the European Union in this political context. But the other name that comes up is the Polish President Duda, but also von der Leyen for one particular reason. She was the one who got in here first and presented the Ukrainians with the questionnaire. Remember, that questionnaire to join the European Union, which for them now politically is the thing they care about the most. Now, in terms of what Brussels wants for this situation, well, they've made it very clear that Vladimir Putin is to pull back all of his troops, but they've also sent a message now, which is the relationship between the European Union and Russia has fundamentally changed. This idea of peace through trade that Angela Merkel pushed through for so many years has proven to be wrong. The other point that I think we should stress, and Anne-Marie was there, she saw it firsthand in Poland, is this validation from the Eastern European countries who will say, we were not hysterical and we were not on paranoia when we told you after Crimea that Russia was dangerous. So there has been validation to that perspective of Poland, the Baltics, and so on.
Right. Maria, I have to ask this as we go to Anne-Marie, but Maria, I've got to ask you, with the weather behind you in Kyiv, I noticed that tomorrow in Kyiv it is 51 degrees Fahrenheit. For Faro, we quote centigrade, 11 degrees centigrade. As we enter the mud season, who wins in a war? We just heard from Elena Polyakova that this is a real war. Who wins in the mud of the Ukrainian spring?
It is a real word. And again, Tom, that was the first thing we heard from President Zelensky on a day like today, that the whole country should thank the soldiers at the border, at the east of the country, because they are really spilling blood to help the country. The reason why I'm here now, a year later, Zelensky is still put, clearly is because he decided to stay. That was a game changer, but also because the Ukrainian army has been fighting like hell for a year. Now, Tom, I'm not sure about the weather. I do have to say, though, that electricity is back on for Ukrainians that have been able to adjust. We did not have any blackouts in our hotel. Everything works normally. But beyond the mud season or not, Ukrainians, what they say is what they're really waiting for is that completion of the NATO training, but also the weapons that they're expecting. They had a wish list of 7 items. They have 6. The pending one is the fighter jets. But everything that they have now, what they say is they're waiting for it to arrive in big numbers. They're waiting for those Leopard tanks, which, by the way, American probably talk about this, are now making their way through Poland.
Anne-Marie, what I'd like to talk about with you is actually the situation with China this morning. We talked a little bit earlier on about the ceasefire proposal that the Chinese government has offered. I want to reflect on the report that came from Der Spiegel yesterday evening, which suggested that the Chinese government, or at least a Chinese manufacturer, was in conversations with Russia about selling drones. Anne-Marie, the administration has been very transparent about their concerns about potential escalation and China's involvement in this war. How would they respond to that?
So 2 things. One, they would say that this crosses what they've really deemed in public a red line of lethal aid to Russia. Tony Blinken, Secretary of State, has talked about this non-lethal or dual-use material that's going from companies in China, but they've said that they are seeing potentially indications that China is going to be willing to provide lethal aid. This would be a red line, but Jonathan, we don't know what the U.S. would do in response just yet, but we do know that this is something they've been concerned about, and they have tried to make sure that they warn Beijing to not cross that line. The second thing, I think what you would hear U.S. officials say is that if China was going to do this, this lethal aid, then they cannot be these individuals that want to come out, be global statesmen, and try to talk about any sort of ceasefire proposals, because they obviously are aiding only one part of this party. So it's a difficult moment for the U.S. And just quickly, the other thing they obviously would say is, and you brought this up, these are Chinese companies. But Chinese companies are obviously, what Secretary Blinken would say, one and the same with the Chinese Communist Party.
We're hearing from the British government, from a spokesperson for the British government a little bit earlier in London. Anne-Marie, they said that the Prime Minister would address the G7 on Ukraine later today, and that Rishi Sunak, the British Prime Minister, would advocate for long-range weapons to be sent to Ukraine. Anne-Marie, Maria mentioned the prospect of jets being sent to Ukraine. How close are we to that moment?
So Jake Sullivan talked about this yesterday in a CNN town hall, the president's national security advisor. He said that F-16s did come up in a conversation, but he said this is more of a long-term conversation with Ukraine, and that F-16 jets would not be suitable for the war they are fighting right now. But also what we've seen is we've seen the Spanish leadership go to Ukraine, and they are even weighing the potential for arming them with jets. So I imagine F-16s, long-range missiles, all of this will be discussed when the G7 sit down, the President of the United States, as well as President Zelensky, for this virtual meeting to mark this 1 year on at 9 a.m. It also follows on the fact that the U.S. is also going to announce another deluge of sanctions on Russia and tariffs as well. So this is just them amping up that statement 1 year on, that they are not just committed to the defense of Ukraine, but also that they are going to penalize as much as they can Russia.
Maria, what happened to the lines? The lines in the sand that the U.S. administration, certain European governments were worried about. If they provided certain weaponry to the Ukrainians, it would be an escalatory step. What happened to all of that?
Well, many of them are essentially gone. I mean, we had a psychodrama. This is non-stop debate about the Leopard 2 tanks, whether that would be perceived as escalation from Russia. The Russians, either way, for a year have been saying that they're not fighting Ukraine, that they're fighting NATO. So that's their narrative already. If you look at the Russian, any type of information, they'll say essentially this has been NATO fight already. NATO will obviously say that is not accurate, that what they're doing is providing weapons to a country that is defending itself, and the UN Charter allows for that. The invasion expansion comes from Russia, not Ukraine. I think the last standing piece of weapons that is obviously up for debate is the fighter jets. When I spoke to the UK Prime Minister at the Munich Security Conference, he said potentially that could come. They need to coordinate, but that could come. And one thing that's becoming very clear that Ukrainians will stress is that no war has ever been won if you don't have the capacity to launch the long-range missiles, because you need to give headway to your soldiers. And then secondly, if you don't control your skies, it's very difficult to push for a counteroffensive.
Maria, we appreciate it. On the ground in Ukraine, alongside Anne-Marie Hordern over in London on the one-year milestone of this war. We did have a ceasefire proposal from the Chinese government a little bit earlier on today. It was a 12-point ceasefire proposal. On those proposals,
excuse me, what was point 8?
Well, I can go through some of them. It included a ceasefire which would freeze Russian troops in place on Ukraine.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Equities a bit softer here this Friday morning. Good morning to you all. Equities down 0.6% on the S&P. On the Nasdaq down 8 or 0.9%. Heading for a week of losses on the S&P 500. Said that now for 3 weeks running. Can we escape that? We're looking for a bounce. Let's see what the data tells us in about an hour from now. We'll talk about that data in a moment. Going into that data, yields higher on a 2-year for 5 straight weeks. Yields up again by a couple of basis points. Your 2-year right now, 472. That is the closing high of this hiking cycle on a 2-year yield. Very, very close to it. Ultimately, we haven't been at these levels really since 2007. It's been that long. Now we're talking about 6% Fed funds. We'll get to that in a moment. What's the prospect of that actually happening? And much higher over at the ECB than we thought a year or so ago. Let's talk about the euro briefly. Yesterday, Eurozone core CPI, all-time high, record high. Out earlier today, the Bundesbank president saying, guess what, we've got more to do. 50 coming up in March, and maybe they'll make a push to do the same again. 105.71, negative here on euro dollar by 0.25%. That's a weaker euro for 5 straight sessions. So Badra Japper and SocGen of the team last night, Tom, put out a great note. Just one word, tricky. Strong. Just one word, tricky. It was the quote in it. The case for higher terminal rates is clearer for the ECB than the Fed. Hence, we expect treasuries to continue to outperform relative to bonds. I have to say, Tom, you know, even 6 months ago, to have this conversation about the ECB maybe pushing 4% on policy rates,
still just like mentally.
And now that's becoming a real conversation. I just wasn't there either.
Bring this up with Ilarion when you talk to him. I just don't get it. I just don't get it on a nominal GDP experience. Here's why you should lean forward, folks. Subrata Japa with us now. Yeah, ahead of U.S. rates strategy at SocGen. But what you need to know is the derivative mathematics of Société Générale was invented quantitative finance with a nod to Imperial College in London. Subrata was steeped in this at New York University with the late Peter Carr, with a major hat tip to a guy named Merton from MIT. Subrata, I want to go to Merton right now, who won his Nobel Prize for continuous functions. We are as disjoint right now as I think I've ever seen. A pandemic, blah, blah, blah. How disjoint are we? How can SocGen do mathematics now, given the stew that we're in?
I think ultimately in an environment like this, you have to look at the long term. I think looking at market moves day to day, week to week is going to be very, very difficult to predict directionality, because there's just a lot of a confluence of so many different factors to take into account. Even if you look at our own forecast for last year, you know, we kind of moved 10-year yields, you know, the goalpost for 4%, and we kind of stayed there. We ultimately got there. So you kind of have to look at the longer run. I think intra-week, intra-month moves are going to be very, very hard to predict in an environment like this.
Okay, I'm going to go on a Friday. It's Global Wall Street Friday, folks. Keep up here if you're taking notes. There'll be a quiz later. Subrata, Roman Friedman at your New York University invented the measurement of hedging. If we're going nowhere and there's a cost to hedging, how long can we keep this going nowhere shell game up before we get a vector that shows actual movement?
So, I mean, it's not like we're not going anywhere. I think every time we get more data, more information, we're kind of adding to what we know and informing our decisions based on that. You know, the Fed, for instance, is almost at the end of its rate hike cycle. So really what we're looking at is to see when that pivot will be. Calling the timing of the pivot is going to be very, very difficult. But I think the destination is clear. Ultimately, the Fed wants to orchestrate demand destruction. Under those circumstances, what you're going to see is a slowdown in the economy eventually and a recession. And that to us would mean that yields would have to go eventually lower. Timing when that's going to happen, exactly when that pivot's going to happen, is extraordinarily difficult. But I think you know, for the most part, we know what the destination is. We just don't know what the journey is.
Well, we've got to manage a balance of risks around every view. Reading your research, Badra, given what you've just said, do you think the risks are asymmetric and not that balanced?
Yeah, I think so. For the bond market, it feels like the risks are a little bit more asymmetric. We're not at the beginning of the cycle. We're close to the end of the cycle for the Fed. Yes, the Fed might maybe deliver, you know, maybe 2 or 3 more 25 basis point rate hikes. But after that, I think that broadly speaking, the risks are that yields will go lower from there on. So we feel like the risk to these treasury yields are asymmetrically skewed towards the downside as opposed to the upside. And, you know, this is, of course, a very asynchronous environment. You look at the ECB, they're still very much earlier on in their rate hike cycle. They have a lot more to deliver. But broadly for the U.S., I feel like there's just going to be a wall of cash that starts entering the bond market again when 10-year yields start getting above 4%. Fixed income assets in general, you look at corporate bonds, even ETFs, you're seeing a tremendous amount of inflows into the bond market. So I think that sort of wall of cash is going to cap the rise in yields over the near term.
The title of your note yesterday evening, and I was sitting in bed because I go to bed at 7 p.m. because we're really sad here at Bloomberg Surveillance. So I was sitting there reading SocGen's latest note, Tom.
I beat you by 2 hours.
Thank you. Titled Tricky. It's titled Tricky, Subhadra, and I think everything about this is tricky at the moment. I was thinking about where we were 12 months ago. Tom and I, Lisa too, we were all having this conversation. If you'd said 5% Fed funds pushing 6%, and then said 3.4% unemployment, and retail sales where that is, jobless claims where they are, I just wouldn't have believed it. And Subhadra, the same thing with the ECB. This idea we're now going to push 4% from -50 to go out to 4%, just like that. Only 12 months ago, we were still doing QE in the United States. Subhadra, have you been surprised? What's your experience been, your takeaway from how this cycle has gone and what we haven't seen, which is just monster fallout so far?
Yeah, no, this cycle has definitely surprised everyone in every country, if you will. In the U.S., we were not expecting, the Fed funds rate to get to 5.25% or 5.5%. And I think it's definitely more shocking for the ECB. You're looking at, close to 4%, when it's all said and done. So definitely this whole, inflationary environment has been very, very hard to gauge. And monetary policy for the most part is a very blunt tool. So the only thing that central banks have in their tool chest is to be able to raise rates. And as they raise rates, I think ultimately they're going to lead to demand destruction.
Subhadra, we've heard, I think, twice this week, the rationalization that's okay if fixed income prices go lower because now I'm earning a coupon, which makes the capital loss less painful. All my radar is up on that analysis. Does the coupon save me if we get higher yields?
Absolutely. That's the reason why you want to be involved.
See that joy? that was that sell side joy. Keep it going, Subhadra.
No, I mean, it's the coupon that really matters, right? I mean, in some respects, you're in some sort of a win-win situation, if you will, in the bond market. Either you lock in a 5%. Coupon, and you're happy with that, or you could see an environment where you see a flight to quality, or the Fed has to pivot, and you see this rally back and flows into bonds. It's going to bring bond yields lower. So, if you, in the broad spectrum of options you have to invest in the investment world, you probably don't want to put your money into risky assets or equities. Bonds are your safe haven bet. You're getting very high coupons, high yield. And you have the upside from a potential rally in bonds if there is a policy pivot.
If we near a 6% terminal rate, where does a 10-year yield go?
I think the yield curve is going to remain, relatively inverted. You're looking at, negative 80 basis points in 2s, 10s. I don't see why the long end will sell off a lot and the yield curve will steepen, unless the Fed is thinking about pivoting on policy. So this is very much going to be a front-end led sell-off in bonds. The yield curve is going to remain inverted for a good portion of this year. We'll be looking to see when that yield curve starts to steepen, i.e. bull steepen, and as a sign, if you will, of when the Fed might potentially pivot. Our view is that the U.S. economy is going to go into recession in early 2024. So in the latter half of this year is when we really think the yield curve will start to steepen out. So that's the signal that we'll be looking to see if there's going to be a policy pivot.
So Subhadra, I asked this, understanding that it's different for different people with different risk tolerance and different situations and circumstances. I get that. But are you advocating for people to buy the 10-year at 4 instead of the 6-month at 5, given the investment risk, the reinvestment risk that you think might be down the road as yields drop?
I think you should do both, right? I mean, if you're looking at you're getting very, very high yields in the very front end of the yield curve. I would say that a lot of investors, even in their personal accounts, you start looking at 5.5% returns in the very short end, it's very, very attractive. If you have cash to put to work, you'd probably want to put it in the bill market or the front end of the bond market because your returns are going to be very, very high and safe. You have a lot of volatility if you put that money into risky assets. On the long end, I mean, if you're looking at, say, an asset liability manager, a pension fund, or an insurance company, you start getting 10-year yields close to 4%. It starts looking very, very attractive for some of these longer-dated asset liability managers. So I think you're going to see different buyers in different segments of the yield curve, if you will.
Well said, Subhadra. Just brilliant.
That was, folks,
fantastic.
For those of you who are not in global Wall Street, what a window that was.
She's awesome.
To how adults think in the industry.
Yeah.
The life that we have, folks, just as a window into it, is really unique. And John and I are making jokes about it, but we're really sort of doing this 24/7. I mean, team surveillance, really for all of us, including our booking team, is pretty much 24/7. We pretend to have lives. And of course, part of it is a comfort, John, that we have to have. And of course, Farrell can do this and get through a long week by the jammies in bed. And I mean, I'm sorry, it's just great. John got these. I think Qantas got these for you off of.
Was that my Christmas present?
These AC Milans. I mean, it was Secret Santa. Secret Santa.
I'd love that.
AC Milan.
As a kid, that would have been awesome.
That would have been like everything, right?
Oh my goodness, yeah. Nothing else matters.
And
that was just my dream.
Red Sox jammies and that.
I just had this dream as an 8-year-old that I was going to walk out onto the turf of the San Siro. You know, just obviously that didn't happen.
I played catch with one of the kids in middle center field at Fenway Park with Nerf balls.
That's special.
And I burst into tears.
Same.
I burst into tears.
I would burst into tears if I did that right now.
I burst into tears.
Got to make that happen. Do you know what I was actually reading last night? Thinking in Beds. Annie Duke, rereading that. Such a great book. Just fantastic.
You know, it's what we do. We're doing this, and we'll be here. We're going to work through the weekend here to next week, which is going to be interesting with that Jobs Day delayed. It's another
couple of weeks away.
Another week of weirdness.
2 Fridays away. Futures negative here, 610s. Dan Tannenbaum in the studio. Up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. It's been 1 year since Russia invaded Ukraine. The U.S. and other G7 nations will mark the occasion by opposing more sanctions on Russia. The defense, energy, and metals industries will be targeted, along with financial institutions and more than 200 people. And there's likely to be a crackdown on those who help Russia evade sanctions. Poland will begin sending German-built Leopard 2 tanks to Ukraine today. The Polish government has promised to deliver 14 of them. Earlier this week, Spain said it may increase the number of tanks it's sending to Ukraine from 6 to 10. Illinois Governor J.B. Pritzker says he's willing to spend what it takes in the next election to help President Joe Biden keep his job. And he told Bloomberg he wants to keep Republicans like Donald Trump and Ron DeSantis out of the White House. Pritzker is a member of one of the world's wealthiest families with a net worth of $3.7 billion. American Airlines Chairman Doug Parker said two other directors plan to retire from the board. Now, the move comes a little over a year after Parker stepped down as CEO, where he oversaw the merger with U.S. Airways. Greg Smith, a former Boeing CFO who joined the airline's board last year, will take over when Parker leaves at the end of April. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
We should never forget that the main source of this uncertainty is exactly the Russian invasion. And we are not saying this only because it's 1 year today, but because this invasion increased all the fragilities of the global economy.
That was Paolo Gentiloni there, the European Commissioner for the Economy and former Italian Prime Minister, speaking on the 1-year milestone of the war in Ukraine after Vladimir Putin's invasion. From New York City this morning, good morning to you all. Equity futures -0.6%. In about 44 minutes from now, we'll have some economic data in America. We'll get another read on US inflation, a so-called PCE deflator. Mike McKee's going to tell you what on earth that is if you don't know what it is. In the bond market, your 10-year 390.62, yields up about 3 basis points. And crude, $76 on WTI, up 0.9%. I have to say, Tom, given how long this war has gone on, if you'd told me crude was back down to 76 12 months ago, I would have struggled with that too.
Or ruble dynamics. How wrong did I get ruble dynamics in March and February of last year? I don't have the compare and contrast there, but I think you're dead on, John. 83 on Brent crude, and still people model with the China Pacific Rim reopening a story out to $100 a barrel. It's still floating out there.
There's some comments from the Treasury Secretary, Janet Yellen, earlier on to MSNBC, saying the following: U.S. support for Ukraine is lasting, is unconditional, warning that China, if it helps Russia, provokes consequences. Now, Tom, I go back and refer back to that Der Spiegel report yesterday evening, which didn't identify sources but suggested that there was an ongoing conversation between Russia and a Chinese manufacturer over providing drones to the country.
Why wouldn't they provide drones? I mean, I don't get. I mean, they got 14 factories in 17 cities that can do it, and that's a long border.
It depends how you look at the situation. Ultimately, if that happens, and I'm far more interested in the if it happens, do we end up in some form of what some people might describe, Tom, as a proxy war between the United States and China? That would be something almost unthinkable 12 months ago, but here we are.
Or 2 decades ago.
Sure.
I mean, I think it carries right on. On this anniversary of Ukraine, we are taking many different tacks with Maria Tadeo in Kyiv and Amory Horton in London. And now someone that has given us wisdom over the last year. He has trained with the Federal Bureau of Investigation people on sanctions, people on security. He is Daniel Tannenbaum, global anti-finance crime practice leader at Oliver Wyman. He's banned in Boston and banned in Moscow as well. Honored to have you here, Dan. What's the next marginal sanction do? I mean, is there such a thing as a marginal sanction, and is it going to have any effect?
I mean, I think today what you're going to see out of the Treasury Department and the G7 coalition is a fairly large package of additional designations, additional focus on kind of metals and mineral sectors to further constrain the Russian economy. I mean, speaking about this, I think it was on February 22nd of last year, I mean, Russia is well on its way to becoming kind of another Venezuela or Iran in terms of economic isolation. But these sanctions continue to constrain the Russian economy. What you're going to see today and henceforth, and frankly, President Putin has had a very bad week for a variety of reasons, is the allies to Russia are going to begin to get more reminders of why choosing that side is not the best choice going forward.
I went back and looked 1 year on from Pearl Harbor. I looked last night. New York Times, by the way, folks, fantastic ability to look back at their archives to the Civil War. And I looked at December 7th of 1942 and all the agony, including Guadalcanal and what are we going to do in the Pacific and what we're going to do in Europe. This isn't World War II because we're so visible. How does sanctions, how does your world work given the media immediacy we're all living?
Yeah, and I think right now, the concern around China, any sort of proxy wars, especially looking at the global south, you're really beginning to have companies look at where they're operating around the world and where they may be on the wrong side of a broad multilateral coalition of support for Ukraine and Ukrainian efforts at this point. So you have companies that are really beginning to take another step back, similar to what Jeff Sonnenfeld has been covering through Yale of the companies who have exited, to really see, can we afford to stay in this market? On the flip side, Russia has made it near impossible for companies to easily exit, so they're beginning to nationalize businesses of Western companies. So this is a situation where the sanctions can further constrain Russia, but right now you're beginning to choke off those allies that are helping Russia continue to fight this illegal war in Ukraine.
Let's talk more about that. The United States has been very transparent about concerns that China will provide lethal aid to Russia to engage in this ongoing war in Ukraine. Have you given much thought to what would happen if they did?
Yes, although I think the focus for the last 6 months has been what happens if China escalates tensions with Taiwan and what is the market impact on that. I think it's pretty safe to say, this week for U.S.-China relations, you saw China announce last night a 12-point peace plan that I think the NATO Secretary General unilaterally slapped down today. You saw the U.S. yesterday, it was announced in the Journal, moved 200 troops into Taiwan. So, there's a real potential for escalating conflict, but I do think both the U.S. and China have been quite measured historically on any potential interaction because of that market feedback. And I think China has said the right things, but the material support they've actually provided in reality, I don't think matches the rhetoric in terms of tangible support.
Are you saying the U.S. concerns this week are misplaced?
The U.S. concerns this week are not misplaced, but I think realistically, this, as we mark the one-year anniversary, is really about putting those who would choose Russia over this coalition of over 140 countries going forward, and really trying to make them understand that if they make those choices, there will be economic consequences. Now, what those look like, the designation package that's going to roll out at 9 a.m. is going to be large, but will it have any major names on it? I would be surprised.
Well, that's the point. For it to be effective, there needs to be real hard consequences. What are the consequences?
So, historically, the U.S. has been a big believer in the stick. And we remember for a decade, large European banks were fined quite heavily from U.S. authorities for sanctions violations. That ultimately helped reinforce the choice for countries to join the Iran deal 5 years ago. When you begin to look at this, there will be a potential cost to companies should they be on the wrong side, but you really need to see follow through on enforcement. Otherwise, without that, it's just words.
I had my intern, Maren Nightingale, do some research here on the history of sanctions, and they go back to 400 BC. This has been going on for decades. Is there a suddenly to sanctions where they do this, they ban you, you're banned from Moscow, you're sanctioned, whatever, but we do it, or what we're going to see from President Biden today? And then is there a suddenly where they break down, or are they just a gradual thing?
It's a gradual squeezing of pressure. So you're constantly looking to isolate an economy to force a change in behavior. That's what sanctions do. And sanctions are kind of a slow bleed as you begin to try and isolate an economy further. In this instance, though, you have some of the largest trading economies in the world that are continuing to help prop up, with huge borders, continuing to prop up Russia.
What does a guy like you do with tractor trailers or trucks with canvas over them at 2 in the morning?
Well, I don't do anything with tractor trailers with canvas.
There, right? That's how they're moving this stuff around.
They're out there. Russia has amassed a large shadow fleet of tankers. There's ship-to-ship transfers trying to move oil products kind of in contravention of sanctions. What do? It's only so good as you can follow the money and find the bad actors that are really on the wrong side of this and enforce these penalties to make them realize that there's a true economic cost.
Well, never mind following the money. Let's follow the crude. I don't know if you saw this story in the last week or so, but Gillian Lee, Alberto Nardelli, and Slavokov here at Bloomberg wrote a fantastic story about the crude coming out of Russia and where it's going. Here's the lead paragraph. Millions of barrels of Russian crude and fuels have been switched between tankers just a few miles off the coast of Greece, one of a series of workarounds that traders have used to overcome EU sanctions against Moscow. What do you make of that?
This is where you need to see companies that are found to be perpetrating these acts actually be penalized for carrying this out. There's also gaps in the sanctions. This is not the most sanctioned country in the world. There's been kind of mixed reporting over the last few weeks on this. Russia has a substantial amount of designated entities, but broadly, there's a lot of practices that are still allowed. Now, while there's a heavy focus on energy sanctions, there's still certain loopholes that companies have been trying to use to get around this. But again, you're also seeing this happen in countries where there's no enforcement of EU sanctions, so there's limited consequence.
What is have you seen any evidence that there's been a bad party, a bad actor, if you will, and we've gone after them? I mean, is there some company that screwed up and Lithuania went after them or America went after them?
There have been a number of companies over the last year designated for helping Russia evade sanctions, but these are not going to be companies that the viewers of Bloomberg are going to be widely familiar with. And that's the point. We really need to see known companies put on notice, whether it's through enforcement or being named and shamed, to really help drive the point home of what these consequences can be.
Dan, this was insightful. Thanks for being with us. Yeah. And I can't believe that we are here a year on, and ultimately with no end in sight. Dan Tannenbaum of Oliver Wyman, thank you. Equity futures right now down about 0.7%. The attention's going to shift towards the economic data in the United States of America. That is 34 minutes away. Another read on the inflation story in the United States and a ton of Fed speak a little bit later on this afternoon. You'll hear from Waller, Mester, Bullard, all the hawks out in force.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing is connected. Our people, our plants, our animals, descendants of Ranganui, the Sky Father, and Papatuanuku, the Earth Mother, and their children. And so it follows that people and nature are kin, are family. And we must care for one another in the spirit of kaitiakitanga, which translates into guardianship by the people of the land for the next generation.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
The data stream has been undeniably strong on services, on jobs, on retail sales. Consumer strength is resurgent.
With the data that's coming in, it's just hard to fight that Fed mantra of hawkishness.
There has to be a question about whether or not they are tightened sufficiently.
Our economy naturally wants to grow. It needs to kind of break something to get it off those growth rails.
The monthly data has got another month or two of choppiness, and then I think you're going to continue to subside.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television on a Friday with interesting economic data coming up here in 29 minutes. Lots to talk about, including this one-year anniversary of Ukraine. I think we had some great chat with that, including Dan Tannenbaum as well on sanctions. But John, the sanctions is the economic data is what the Fed is dependent on.
29 minutes away. We are data dependent. How dependable is that data? Based on some of the comments we've had, responses to surveys have been declining, Tom. We'll talk about that a little bit later, but ultimately the next stop for this market is the PCE data, 29 minutes away. Then after that, Tom, I think I picked up on a phrase that you used yesterday. We're hungry for the payrolls report, two Fridays away, without a doubt. And we've all got one question. Will it confirm the strength we saw in January? I'm not asking for another 500K payrolls print, but certainly anything north of 300 with unemployment at 3.4
would be huge.
That's going to be introducing the question as to whether this Fed has to go 50.
That's a 2-month moving average of 400,000 jobs.
That's a big move.
Never imagined that as well. Subrata Rajap of SocGen really emphasizing labor economics within her bond analysis. John, I look at this and we can't forget 10 o'clock. You're gone by 10, aren't you? You're gone by 9.
you and I are both out of the building at 9:56.
9:56 sharp. New home sales, and a backstory to me is with the new rate regime, 10-year yield 3.91%, and a shock out to 3.97%, is what does housing do here as we go to the jobs report and stagger into March?
You know, I'm not an expert on the U.S. housing market, Tom. Far more knowledgeable about the U.K., given that I'd lived there
What have floating rates done there?
It's amazing just hearing people here in the United States and what they say about their mortgage. I had a lot of people turn around to me yesterday and say 3%, and I'm not giving it up. I'm not moving. I've got 3%, 30-year fixed, and I am not going anywhere. You cannot take that away from me. It's going to be really interesting to see what happens with transaction volume in this housing market, given we've got a whole generation of people locked in at pandemic-era rates.
And over to commercial real estate, John, you featured the PIMCO consortium, I'll say, of cities and commercial property. Now, the reason I'm bringing this up, folks, is outside the blah, blah, blah of finance, there's real-world ramifications going on right now, whether it's housing or labor.
So we were talking about residential real estate. Need to talk about commercial as well. And the funds that invest in that, Tom. The withdrawals.
It was like a 7-year timeline. It's not like, we're going to own it forever.
Just more and more of those withdrawals starting to pop up. And these financial institutions, these asset managers they'll have to handle that.
Let's go to the data here, because we got to get to Joe Quinlan, because we got a lot to talk about in this hour, getting set for the weekend reading, and moving forward into next weekend. On the data, it's just simple, John. The VIX, I should have not come in. I should have taken off Monday, Tuesday, Wednesday, Thursday. Nothing's happened. VIX 21.
Thursday was a mess. Did you see the price action yesterday?
It was a mess. It's accurate.
All over the place. What did Julian Emmanuel say of Evercore? He said intraday price action disrupted maybe by
versus inter.
Yes.
Intra versus inter. This is a huge focus in the study of volatility, is looking within the unit versus outside the unit, intraday.
One observation of what's happening right now on the screen. Bonds down, equities down.
They nailed it.
Weren't we going to snap this? Yields up, stocks down. Down 7/10 on equity futures. We're up 3 or 4 basis points on a 10-year, back through 390 TK, 391.40 on a 10-year maturity.
To reset for the weekend and into March. Joseph Quinlan joins now. He's head of CIO market strategy at Merrill and Bank of America Private Bank. Joe Quinlan, wonderful to have you here. I'm glad I'm not managing money. You are. What have you changed in the last tumultuous week?
Well, Tom, we have seen a capitulation on the part of our clients just to go into cash. I mean, they realize equities outperform cash and fixed income long term, but really, people, you talked about it earlier about the 2-year yield, 4.7. They're grabbing that yield right now. So that's what we've seen. But we're still optimistic about looking into 24 and 25, U.S. centric, so to speak. But we've got a lot of big hurdles to clear, and you touched on them: the war, the Fed being done raising rates. We're not there yet. So cash seems to be king right now.
Joe, let's talk about opportunities to get out of cash. Here's one for you. It's your phrase. What is FANG 2.0? What is that?
So FANG 2.0 is, John, is simply, we came up with that construct a year ago, actually, 1-year anniversary. It's to hold hard assets, whether it's fuels, agriculture, aerospace is in there as well, nuclears, metals, minerals. Because when you look around the world, there's a premium on hard assets. Energy trade has been weaponized. You're seeing resource protectionism. So you're really seeing kind of the world kind of fragment in and around resources. And this is a good geopolitical hedge, inflation hedge. And so where you can get some return as we wait to kind of normalize coming out of the pandemic, working through the war, and through the interest rate cycle.
Joe, how do you get exposure to those themes? What's the best way of doing that?
John, we've done a lot of work over the last year. It could be individual mining companies, ETFs, broader lithium plays. So that it's a broadly based construct. It's not a single shot, so to speak, but multiple ways you can do that, whether the ETFs, the companies, Australian companies, renewable leaders in Europe. So it's really a global basket of leaders in each one of those segments.
Joe, all of this is about cash and what you said your clients are doing. I get it. Isn't that a contrarian play, looking out 1 year, or dare I say, Joe, what short-term used to be, which was 3 years?
It is, Tom, and we're seeing a lot of folks even go shorter, like CDs even. So, and they're waiting. They want to have their dry powder ready for the other side when we peak in the interest rate cycle. Equities kind of reset with earnings. So I think a lot of our clients are just kind of waiting it out. They didn't buy the January rally. They're still licking their wounds from last year, and they want to be set up for the cash, for the equity rebound into 24 and 25. So they haven't given up on that. And we are seeing the 60-40 come back, that conversation. That's very live as we speak. But I think folks are just kind of tired of kind of the uncertainty in and around where do we go next with hotter data. And now just willing to sit this out and be positioned for the rally into 2025.
You're making it sound like a bull signal here. What's the percentage of cash that people are asking for? Not what Merrill and Bank of America Private Bank are advising, but what is the comfortable cash you see meeting after meeting?
We're like, Tom, like 20, 25%. That's at the upper range. Some folks are just, say 10%. It's a different mindset because we've had a lot of clients, be all in on equities for so long, and it's worked so well. So now definitely that cash cushion amongst the accounts are rising in anticipation of better places, opportunities with the drawdowns in the markets to step in. So we're kind of advising, we're looking for the recession in the second half of this year. Earnings are going to reset. Then we're going to start to slowly but surely put the cash back to work in the equities into next year and beyond.
Joe, we've had this discussion over the last couple of weeks. Do you stick at the front end of the curve? Do you push it out and take on some duration in the bond market? Where are you on that?
Shorter durations, John. At the shorter end, in anticipation that we're closer to the Fed tightening cycle peak and we begin again. So at the shorter end, and you brought it up earlier, why go out too far? That's kind of the debate we're having. But people are getting comfortable owning fixed income and cash again, but at the shorter durations because they haven't bought in, all in terms of that asset class.
Hey, Joe, this was great. It's good to catch up. Joe Quinlan there of Merrill and Bank of America Private Bank on the latest. What was that number? 20%? 20% plus?
Big number, yeah.
The
model here on a prospectus is 5% is big, 7% is a real statement of cash, typically 2, 3, 4%. And elevated cash is 8%, 10%, And these clients are just saying, are you kidding me? Move on.
I'll take 5%.
Yeah.
Thank you. We'll sit this out.
Yeah.
Was it Dan Skelly and Morgan Stanley that said last week, you get paid to wait?
Yeah.
I'll get paid to wait, thank you.
And that was one of the great interviews of the week. Brian Weinstein at Morgan Stanley, I thought was really, really quite good. It's your fault. I'm home watching Netflix, and I'm not watching Queen's Gambit or, Wednesday.
Oh, you're into
I
F1
love Wednesday.
now.
But I'm really into Formula One, except I'm into Formula One, folks, from 5 years ago. And it's like the Titanic. Everybody's moving their chairs. Bahrain's coming in. We're going to be in Bahrain, folks. Team coverage.
What, next weekend? You've got that down.
It's like in March, early March, and I'm reading my magazines.
Well, drum roll, reveal. Who's your team?
My team is Aston Martin.
There
Very
we
Bond.
go.
I watched all the Bond movies, including Goldfinger, where, he changed the image of the company. And, I got to be in there because Fernando's driving, and he's almost as old as me.
He's an absolute stud, absolute legend, Fernando Alonso.
Also, these guys are brave folks. There's a scene in the Netflix, what's it called, Driving with Pharaoh, something like that?
Isn't it Drive to Survive?
Drive to Survive. Well, Mr. Fernando was, and I'm sorry, I make jokes about it. This guy's a huge rock star. And his car goes directly over another car. He's sitting up in the car going over it against the
It's
wall.
much safer. They've got these halos on top of the top of the cars now.
But Aston Martin looks good. I mean, they're going to have the new Pirelli tires. They're not going to use the CO tire the first 3 races.
You're going to get so into the engineering of this sport. I can't believe it's broken America finally. It's taken this long. And off the back of the Netflix series.
I read one article, very British, and folks, let's be honest, Formula One is steeped in the British heritage. And John, they make no bones about it. America, including me, was dumb as wood until, Netflix has it. It's okay.
It's finally broken this country. Did really well in Miami. I wasn't a fan of the track last year, but ultimately it's coming back.
Do you know where I really first heard about it recently? Because Ken Pruitt, the late, great Ken Pruitt, folks, gave me grief
Ken
about
tried
this.
his best on this with you, didn't he?
He went down in flames on this. What I found interesting is Magnussen, who was on another team, won the Indianapolis 500 last year. It's not the same as Indy, right?
You see, I knew that within about 2 months of you enjoying this, you'd know more about the sport than I would.
David Ricciardo, he should drive for Aston Martin. Yeah.
He needs a seat.
He needs a seat.
He needs a
right
seat.
now.
It's sad.
I can't fit in the seat.
No, I don't think I can fit in the seat either. Those guys are tiny, you know.
Yeah.
You know how much strength training they've got to do for their necks?
I'm stunned.
Because of the
Yeah.
G-force. Oh.
Yeah.
Proper sport. Futures, negative 0.75% on the S&P. Data, 18 minutes away.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The U.S. and other G7 nations are marking the one-year anniversary of Russia's invasion of Ukraine by unveiling new sanctions. The measures will single out Russia's defense, energy and metals industries, financial institutions, and more than 200 people. There will also be more pressure on third countries to choose between the U.S. and Russia. Meanwhile, the mayor of the city of Kyiv says Ukrainians will not give in to Vladimir Putin. Vitaly Klitschko spoke to Bloomberg's Maria Tadeo.
He wants to rebuild Soviet Empire. They don't never accept Ukraine as an independent country. They told Ukraine was always part of Russia. We Ukrainians don't want back to USSR. We see our future as part of democratic European family. We're fighting for that.
Ukraine's President Volodymyr Zelensky will speak about the war at a press conference today. The U.S. and South Korea are planning for a potential nuclear attack by North Korea. A so-called tabletop exercise was held in Washington, focused on hypothetical scenarios of North Korea's use of nuclear weapons. North Korea has been building up its capability to deliver an atomic strike. And the billionaire private equity pioneer Thomas H. Lee has died. Lee ran his Boston-based firm from 1974 until 2006, when it had $12 billion to invest after producing triple-digit returns on some of its deals. His best-known transaction was the 1992 takeover of beverage maker Snapple. Thomas H. Lee was 78. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
We cannot take our freedom for granted. Freedom is not for free. We must fight for it every day. Today, it is the Ukrainian people who are bravely fighting for their freedom. And despite a dark year of despair and destruction, their determination and courage will no doubt prevail.
1 year on from the start of this devastating war in Ukraine after Vladimir Putin's invasion. That was Jens Stoltenberg there, the NATO Secretary General. We are about 14 minutes away from some economic data in the United States of America. Mike McKee's in the seat. He's going to break that down for you when it drops. Ahead of all of that, futures are coming in. Equity futures are soft and negative, down lower by 0.8% now, and pretty much, Tom, at session lows on the equity market, and yields near session highs. 474 on a 2-year, up 4 or 5 basis points there. Your 10-year back through 390, yields high by 4 basis points, 392. Bit of dollar strength out there again. Euro dollar negative again for a 5th straight session. We're down a third of 1%, 105.63.
Tape deterioration now. The VIX through 22, NASDAQ down 1% as well. We've taken great pride with the titanic effort of our booking team to bring you experts on Ukraine. I speak of the generals of the American military, General Hodges, General Kimmett, thank you so much for joining us. People in diplomacy, such as Ambassador Haas. And we move that forward today with Yuri Sak. He is advisor to Ukraine's defense minister, but far more is steeped in the diplomacy linkage to military effort, if you will, from diplomacy to attack and defense. Mr. Sak, thank you so much for joining us today. It will be a spring war. It will be on the ground in mud. How do you foresee that tanks will be utilized?
Good morning, Tom, and thank you for inviting me. Now, we have said a long time ago that with the courage and determination of the Ukrainian armed forces, we were able to, and of course with the help of the military assistance that we received from our allies, we were able to stabilize the front, and we are now getting ready for our counteroffensive, which we hope will begin soon. Now, because our military objective remains the complete deoccupation of Ukrainian territories and restoring peace in Ukraine as well as in Europe. So the tanks which will be provided to Ukraine by the tank coalition, international tank coalition, will be instrumental in helping Ukrainian army break through the defense lines of the enemy on the temporarily occupied territories. And we are seeing that, you know, the tanks, the first tanks are already on their way, and we hope that the tank coalition will continue stepping up their efforts and sending us more.
To move out another year in this terrible war, can those tanks drive to Crimea? Do you perceive a linkage of what Kyiv wants on Crimea with what the Allies want on Crimea?
I think the Kyiv and allies are aligned when it comes to the situation with Crimea, because everybody recognizes that Crimea is an internationally recognized territory of Ukraine, which has been illegally annexed in 2014. But when it comes to the actual format in which Crimea will be returned to Ukraine, our military will take that decision when it comes, and most probably it will be a mixture of diplomatic efforts as well as military.
Yuri, I'd appreciate your insights on how close we are to the West providing jets to Ukraine. Do you think we're approaching that moment?
we are pushing for the fighter jets on a daily basis. Our Minister of Defense, our President, everyone from the political and military leadership. And we understand that these are sophisticated platforms that require the training of pilots, the training of engineer crews, they require logistics. So it's not going to happen overnight, but we're doing everything we can on our side to facilitate this process, because fighter jets are the last remaining hurdle, and they will be instrumental in helping Ukraine achieve victory, which we hope will be this year.
Yuri, how long do you think that would take to train pilots and make that kind of thing operational?
Well, you know, we are in a different situation. Ordinarily, training pilots takes about a year, if not more. But we are in a situation where, first, we already have pilots who have combat battlefield experience, and our pilots are ready to be trained in 3 to 6 months. They will be ready to fly these platforms.
Mr. Sack, it's simple. You need material as well. As I asked our Maria Tadeo in Kyiv an hour ago, tell me about the manpower of your defense ministry. Do you have enough soldiers? It always comes down to infantry, doesn't it? The state of the Ukrainian infantry.
Indeed, our armed forces are, we have sufficient reserves, and of course, the reason why we are in a better position than our enemy, whose military capability has been degraded by the Ukrainian armed forces during the last 12 months significantly, is because we are not using our soldiers as cannon fodder. We are not using them in the meat grinder tactics. We are fighting a smart war, and we have a high regard for our personnel. So we take smart decisions, and this allows us to maintain the sufficient number of troops. And of course, where necessary, if we need, we mobilize more people. But for now, we are ready for any development, and we are ready to continue the occupation of Ukrainian territories.
Give us an update on the Black Sea. Mariupol was just horrific 8-9 months ago as well. Discuss the state of the Black Sea as you enter year 2 of this war.
Well, as you know, the Black Sea now, there is the Russian Black Sea Fleet in the Crimea and Sevastopol. So Russia and Russia continues to control what happens in the Black Sea. But of course, we will continue building up our military capability, and this is why we are asking for longer-range missiles, because they will be helpful in terms of helping us achieve our objectives deeper into the enemy's territory and making sure that Black Sea is safe, as well as for things like grain deal, the supply of agricultural products from the Ukrainian territory, which was of concern to the international community for a long time.
Yuri, the United States has committed tens of billions of dollars to support Ukraine and the war effort in your country. There are some concerns where you are in Washington about the misappropriation of some of those funds. How are you allaying some of those concerns?
We are implementing, when it comes to the Ministry of Defense, since almost day one of this war, we were implementing, for example, the procurement systems, which are of NATO standard, the so-called, for example, LogFast system. So these are the same systems as are used by all NATO member countries. And of course, we are improving them on a daily basis. Everything, and of course, the Ministry of Defense is open and welcomes always our counterparties from different ally countries to come and visit and see it for themselves. Everything we receive goes straight to the battlefield and is used efficiently there by our army. So, when it comes to transparency, we are open. We are introducing new standards. We're introducing new NATO standard procurement mechanisms, and we can assure and guarantee our allies that nothing is misappropriated. Everything is going to be used on the battlefield.
Yuri, it's an incredibly difficult time for your country, and on a one-year milestone that we all hoped we wouldn't approach, we've landed on. We appreciate your time to join us today. Thank you, sir. Yuri Sack, the advisor to Ukraine's defense minister. TK, unbelievable, isn't it? 1 year on.
That's a great report. We thanks to our booking team for bringing him. These are the people we want to talk to that are actually involved, experience with military. I go back to chilling conversations in the year with particularly General Ben Hodges, retired of the U.S. Army, and he and Mark Kimmett were heated about keep the war out of the cities. The biggest fear for Ukraine and the Allies was building-to-building combat in the war. And it seems like we've pretty much avoided that in this first year with the Russia devastation.
Just some news on those battle tanks. Sweden to send the Leopard 2 battle tanks to Ukraine, according to the Prime Minister. So, Tom, we're getting more and more of those headlines from Europe.
And they're all coming out today, no doubt, because of the moment.
And those requests for the jets, You heard what he said, that typically it would take anywhere from a year plus to train pilots to operate some of this modern equipment. That's basically what he suggested, Tom. So you wonder, even if we do cross that line, which would be remarkable, how long it would take for that to be operational.
I think what we've got to do now, whether we look at the economics forward or the Seattle slew of emails I've gotten in on Aston Martin, I mean, it's a tough...
And the response on F1.
It's tough to go... But Mike and I were talking in a break about Sterling Moss in the 1959 Le Mans. It was amazing what Aston Martin did.
Those were the good old days.
You know, 150,000 people were there.
Mercedes wants to come. Everybody wants to get into F1.
It's amazing. Mercedes got such a great... I love Lewis Hamilton. Lewis is just an absolute legend.
Do you know,
get Lewis on the show.
Do you know, Tom Keene, Lewis Hamilton is a part owner of the Denver Broncos? Since you like to bring that up all the time.
I did not know that.
He is.
A font of information today.
Mike McKee knows more about sport than you and I put together.
Got that right.
Mike's going to stick with us. Economic data just around the corner. It's about 4 minutes away. Futures are lower, yields are higher. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Mike McKee alongside us in the studio in the seat. You know what that means. Economic data seconds away. We'll get to that in just a moment. Going into it, equity futures lower by 0.75% on the S&P 500. Yields pushing a little bit higher on a 10-year, on a 2-year. On the 2-year, up by 4 basis points, close to 474 on a 10-year, through 390, up another 3 basis points, just short of 391. That economic data dropping right now across the Bloomberg terminal. Mike McKee still waiting for the drip feed of that communication to get PCE.
The embargo.
We have moved to internet distribution, and of course, it's not quite as quick as we would like to see. We're waiting on personal income, personal spending, and here come the numbers. Personal income up 0.6% in January. That is after a 0.2 gain, the initial release at least, in the month of December. Personal spending up 1.8%. That's better than the 1.4% expected. The PCE numbers, here's what you care about, the inflation numbers on a month-over-month basis, up 0.6%, bigger than expected and much bigger than the 0.1% that we saw in December. The year-over-year number for the headline is 5.4%. We were at 5%, so we bounced the wrong direction. The core up 0.6. That is double. Well, that is, now here are the revisions. That is 2 ticks higher than what it was in December. Wow. And puts the year-over-year at 4.7% after 4.6%. So inflation stronger. Personal income is stronger than it was in December, not as strong as expected, and personal spending is up 1.8%. So Americans are still out there spending. I'll try to dive into the details. And John, I bet you have some movement in the market.
I mean, you can guess where it is, and I think everyone listening can guess where it is. Equities are down on the S&P by just a little more than 1%. That's a session low. In the bond market, yields up at the front end by 5 basis points, 4.75. That's the highest level on a closing basis that we will have seen since 2007. On a 10-year, up 5 basis points to 3.93. So, Tom, it's yields up, stocks down, upside surprise again on inflation data. That is not what we wanted to see.
I'm trying to impress Solarian here. I'm going to do the math in my head here, but on the core deflator, the survey with previous statistic was 4.35%, and the data with the revision is 4.65%. 4.35, John, up to a reality of 4.65. To me, that's a demonstrable move.
So I get that it's old news, but Mike, I've got to ask it. If the Fed had the January data on February 1, would that news conference, that meeting have been much different?
I suspect it would have been if they'd especially seen the strength in the jobs report, which came out 2 days after their meeting. And then if they knew where inflation was going, they might not have done 25. They might have gone with the Mester Bullard camp and done 50 again if it had come out that way. Let me give you a couple more numbers here that matter. A lot of talk about people going into debt to keep this spending up, but the savings rate rises to 4.7% from 4.6%, the second consecutive increase. So it looks like people are still saving something out there instead of just buying everything on credit.
What does it say to nominal GDP? What does it say to the animal spirit that companies have to adapt to? I mean, inflation can be good for companies too, because revenue comes in better, right?
Yeah, absolutely. For companies, as long as their margins, they're making it on the margins and raising prices faster than their expenses, then that helps them. That was one of the foundations of the stock market for years until we got into this low inflation environment, and that's one reason it's been harder for companies to keep up the kind of growth that they used to have.
So, Mike, I got an email moments ago in response to this economic data, and it said this should be called the core inflator. Now, can you tell our audience, your best place to do this, what is the greatest distinction between the CPI data we had a week or so ago and, say, the PCE core deflator? What is all that?
Well, it'd be PCE, you could just call it an index, but basically they use the PCE numbers to deflate, to adjust for inflation, the GDP numbers, which is why they call it a deflator. It could be easily called, in this case, an inflator this month. But the biggest differences are in medical care. The CPI is what you pay for medical care, and the PCE takes in what insurance pays as well. And then in housing is a much smaller component of the PCE than it is of CPI, so that does matter. I'm looking here to see if we have an update on the number that does matter, which is the core services X housing. And let me just type this number in here and see what we got. It hasn't updated yet, our numbers, but we'll continue to look for that, and we'll talk about it on your show, John. One thing I can tell you is that wages were up a huge amount in January. Now, this is not totally unexpected because that's when everybody gets their raises, but they were up 0.9%, which follows a 0.4 gain. And then the one that everybody's going to want to see here, or we're going to want to see, is Social Security, because of the big increase in the COLA this year.
Yeah,
Social Security payments went up 9%. So that's going to be one of those graphs that breaks the graph like we had with jobless claims during the pandemic. So that's where a lot of this increase in incomes comes from. And incomes were lower than people thought they would be.
Mike, this was great, as always, and we will talk about it in the next hour. Equities are down off the back of it. Session lows down by 1.1% on the S&P, down by more than that, approaching 1.5% lower on the NASDAQ. Yields are higher on a 2-year, 475, up by 5 basis points on a session. The 10-year up by 5 basis points to 392. In the next hour, Mohammed Al-Arian for the hour.
Never wants to talk
for
to
the
me.
hour. You can drop by, TK.
I'll do that.
Come join us.
On a break, yeah, I'll come
Do
back.
that. Gershon Distenfeld of Alliance Bernstein, George Goncalves of MUFG.
Very good.
We're also
George,
going to catch
great,
up around the opening bout with Kate Moore of BlackRock. So all of that coming up in the next hour on Bloomberg TV, Tom.
Very good. And we will march forward here now with the perfect guest. For Global Wall Street, it's time for a brief on the theories that are out there. Vincent Reinhart literally has lived them at the Federal Reserve, and he knows, going back now, he's chief economist, Dreyfus and Mellon. But Vince Reinhart, I know you remember that paper we all read in November of 2021 from Laubach and Williams. And the modern theory is founded on our star and that first effort that I recall, measuring the natural rate of interest. Do we have a clue of where this theoretical foundation is right now, Vince Reinhart? Do we know where our star should be or is?
Well, remember, Tom, the concept goes back to Newton Excel a century ago. And the answer is we haven't made a whole lot of progress in the 125 years since. We may have gotten a little bit more sophisticated on the econometric technique, but it's just hard to tell. The basic story is we were working pretty much at or close to potential for the last couple years. The real rate was negative. Must be the equilibrium real rate is pretty low. That's one way of estimating it. That's essentially how Laubach and Williams does it.
I mean, let's move then farther back to Phillips at London School of Economics with the certitude that you had with Chairman Greenspan that somehow labor and inflation were linked. Are they?
Well, we care about the supercore right now exactly because of the link between wages and inflation and resource use and wages.
I think we're having some trouble here. We'll try to get that back. We'll see what we're going to do here with the control. Now, I think we're going to get our linkage set up with Mr. Reinhart again, if we can, at Dreyfus and Mellon. And I am so advantaged that someone here that's read the papers even more than me is Michael McKee as well. Mike, I'm going back to the theories that are out there. When you're in the press conference with Chairman Powell, there doesn't seem to be a discussion of foundational theories that Vince Reinhart helped form. How blind are they flying right now?
I think they're flying reasonably blind. They have updated the basic model that they use, the Federal Reserve U.S. FERBUS, they call it, to try to take into account some of these new factors. But the pandemic threw all the calculations off because you don't have a recent history to go on. So they are trying to figure out as best they can. And I think that anecdotes play a much bigger role now as all the regional Fed Bank presidents talk to CEOs and try to figure out what's going on.
We're going to stop on a Friday here, and this is important as we have Vincent Reinhart on. We're going to let Mr. Reinhart go because of those audio difficulties. I'm going to stay with Michael McKee here. And Vince Reinhart in the heart of it with Chairman Greenspan years ago, and Mohammed Al-Arian coming up, who's been an acolyte of away from transitory, along with Secretary Summers and others, is this massive debate over where is our starred and where will it set. Mike, as you read all of this literature, who's winning the battle? People that think we'll get back to what we used to know, or are we going to have a new regime with higher interest rates that affect all of our listeners and all of our viewers?
It's really kind of a demilitarized zone right now instead of who's winning, because we don't know. It's going to become one of the major topics of conversation as the year goes on. I bet you hear a lot about it by the time we get to Jackson Hole, because the question is, do we go back to the old normal? Do we go back to Mohamed El-Erian's new normal, or is there a new normal? And where does R star go? Now, we should explain R star as the potential growth of the economy, the growth rate of the economy that doesn't produce inflation. How high can we go? And the feeling is it's moved up a lot right now. Right. But does it stay that way, or does it ebb away? And that's the hard part. When you're trying to hit a number that you can only divine in hindsight, it's kind of hard to do. But this has started to become an issue. There's a big paper by the folks at J.P. Morgan, Bruce Kasman and Company, the other day, suggesting that R star has moved
I
up
read this
significantly.
paper right away. Bruce sent it to me, actually. Thank you, Dr. Kasman, for sending it. This is a heated debate, and it's a combination of people with Dr. Kasman really thinking about it. What's the big so what here for our listeners and viewers? They don't care about our starred. They've got mortgage rates that have stopped the housing market. They can't afford to stay in a hotel. They're looking at tuitions, whatever, up 6%. What's it mean for the viewers?
Well, I would put this in the terms of what Will Rogers said about Congress, sausage making. You don't want to see the sausage making going on. This is the sausage making for economists. How do we figure out how far the Fed has to go, whether you're on the outside or whether you're at the Fed? And one of the questions you have to ask is, at what point are interest rates so restrictive that it starts to slow the economy? And you don't know where that point is, so you're looking for this magical R star.
Michael McKee with us, and he'll dive into the data. Tons of data coming up. Folks, frankly, what I'm interested in is the housing data that we'll see at 10 o'clock. I'm sorry, I'm focused on what does this mean, 6.9% mortgage rates. It's got to change our world. Stay with us. This 1 year remembrance of the war in Ukraine. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Yes, it's been 1 year since Russia invaded Ukraine, and the U.S. and other G7 nations will mark the occasion by imposing more sanctions on Russia. The defense, energy, and metals industries will be targeted, along with financial institutions and more than 200 people. And there's likely to be a crackdown on those who help Russia evade sanctions. Poland will begin sending German-built Leopard 2 tanks to Ukraine today. The Polish government has promised to deliver 14 of them. Earlier this week, Spain said it may increase the number of tanks it's sending to Ukraine from 6 to 10. Taiwan is emphasizing that there are no U.S. troops stationed on the island. That comes after the Pentagon said it planned to increase its presence there. It was the latest sign of Washington's willingness to raise tension with China. A Pentagon official said the U.S. is increasing its small contingents of troops in Taiwan to train local forces. Ericsson will lay off 8,500 people around the world in a cost-cutting measure. The Swedish telecom equipment maker employs about 105,000 people. In December, Ericsson said demand was slowing in some markets, including North America. It laid out a plan to cut $865 million in costs by the end of this year. And Goldman Sachs says that investigations and inquiries into its credit card business has expanded. The firm says that now other government agencies are involved, not just the Consumer Financial Protection Bureau. Last year, Goldman said the CFPB was looking into how it resolves incorrect bills and processes refunds. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
As the figures have come in, and particularly the figures on non-housing services look to be running way above target level, I think the chances of a soft landing, which looked to be getting better a couple months ago, I think are now receding a bit.
I will not mince words. On a one-year anniversary of the war in Ukraine, we maybe look at the war of our financial markets as well. And Lawrence Summers has been a winner. He has been a piñata recently, and I'm not going to mince words. The economist from Harvard has just killed it with the idea of what we're living, the idea of higher rates. To recapitulate this, look for Mohammed El-Arian with John Farrell here in the next hour. Right now, to synthesize this, and I'm thrilled that he's with us, Cameron Kreis is head of macro strategy for Bloomberg in all that we do here. And I'm going to go back distant, Cameron, I believe it was 4 days ago, where the chief economist of Goldman Sachs, Jan Hatzius, really adjusted and said, we're going to see sequential measured rate increases. We've got the Hatzius outcome in 4 days. As moments ago, the swap market signified 3 rate rises in a row. What will that do to our listeners and our viewers?
Well, it probably means to some extent that whatever assets they have, the price will probably adjust down a bit further. I think the key question henceforth is 3 going to be enough? I think you can make an argument that some of the sort of the hot January data that we've seen is really just payback from December, which, as you probably recall, was impacted significantly by adverse weather across much of the country. So we probably need to see more data in February and March to get a real sense of the underlying trajectory of the economy. That having been said, we have had some revisions to the inflation data. The price levels and the rate of change is higher than we previously thought a few weeks ago. So the Fed does clearly have to sort of keep taking a pretty hard look at this stuff.
The disinflationary crew looks at a 3-month, then annualized set of series. They look at goods disinflation and say services at one point will follow. Do you agree with that theory?
I mean, in the fullness of time, but how long is the fullness of time? I would note that in the set of data that we just had released, if you look at durable goods, so not food, not energy, whatever, we had durable goods prices rising 0.3% after having fallen for the prior 3 months. So that certainly looks like a bit of a phase change from the immaculate disinflation that a lot of people were using to justify paying whatever price they wanted for financial assets in January. It probably isn't going to be as smooth a glide path down to 2% as many people had thought. I think one of the questions is what the Fed's estimate for particularly core inflation by the end of the year is quite a bit higher than the private sector. So where do we come out vis-a-vis the private sector and the Fed?
Cameron Christ with us on radio and TV here. The data deteriorates. NASDAQ down 1.8%, under 12,000. That's important. Futures down 51. Dow futures down 366. The yield moves higher, but I'll be honest, more quiescent than I thought. 3.93% in the 10-year yield. I was looking for a 396. We're not there yet, to say the least. Cameron, I look at all this, and then I guess, okay, I'm going to go to cash or be sophisticated and go to 3 months, 6 months, maybe 1 year T-bill as well. Do they follow the terminal rate game higher? Can you see them really branching out up to 5.2, up to, dare I say, 5.5%?
Well, yeah, I mean, listen, if the Fed hikes rates to, say, 5.25 to 5.5%, which would put the effective funds rate at sort of 5.33 or something like that, and then keeps it there for the rest of the year, the T-bill market will follow. It might trade a little bit below the effective funds rate, but yeah, we're going to get T-bills up at 5.25% or so, and that looks pretty good. And I think it's particularly an impediment to the sort of specious quality of assets that have been so popular in the sort of zero interest rate world with infinite discount factors. I mean, we may have to go back to the world where the discount factor into the future is significantly positive.
That's a key point, I guess, in all this mathematics. Cameron, what will you write about this weekend for Bloomberg?
Well, funny enough, today I'm writing about how the equity market has chosen a more favorable way of looking at index earnings than they used to, funny enough, always looking on the bright side of life. But listen, obviously next week, we're going to start looking ahead to March. Payrolls is released a week later than it normally is, so not next week, but the week after, and then a couple days after that, you've got CPI. So, it's in the day when we're as data dependent as we are now, it's just a sort of a never-ending. So, in the day when we're as data dependent as we are now, it's just a sort of a never-ending cycle, waiting for the next employment data, waiting for the next inflation data.
I agree.
It's never more than a couple of weeks away.
Oh, it never is. Keeps us going, Cameron. Thank you. Cameron Christ, our macro strategist. We return to Michael McKee here, and I want to bring up a quote, folks, which I hate to say, and McKee and I are the only ones on the planet that remember this. I mean, we're looking back 22 years to this seminal paper on R-Star. This is Laubach and Williams. Williams is John Williams, of course, with the New York Fed now. We show that policymakers' mismeasurement of the natural rate of interest can cause a significant deterioration in macroeconomic stabilization. Mike, could they have written that, say, Tuesday of this week?
They could. The only problem is we don't know if they've mismeasured it or not, because we don't know where the natural rate is. They suspended, this is part of the problem, they suspended the Laubach-Williams series during the pandemic. So we don't have an updated version of where their calculations
they're going to bring it back as we come out of the
R-Star.
pandemic. And I mean, I'm sorry, the theory and the mathematics are being tested right now. And as you said, do we need to get used to a 1970s, even early, pre-Volcker rate regime?
Well, it's going to be a big discussion today at the Chicago Booth Monetary Policy Forum.
Is that forum today?
That forum is today.
Ferroli didn't invite me. Michael Ferroli, ban him forever.
Michael Ferroli, one of the authors of the paper being presented today. So we can talk about that once it's out. But it is a topic of discussion. I did want to mention that we got the numbers for the core services ex housing.
This is
which is
what matters.
This is what matters to the Fed, and what we're looking at is a 0.6% gain during the month, which is kind of crazy, a lot more than people anticipated it would go up. And we're at well, this one is not caught up, but I know we have the new numbers. The total number now over 6% for the gain on the year-over-year number, 4.6% for the year-over-year, and 0.6% for the month. And so those show that core services ex-housing still accelerated.
The minimum, it hasn't turned down. I mean, goods has turned down. We all understand that. Services has to get back to a normal, I'm going to say 3-ish. There's no indication.
Not so fast, masked man. This is the interesting part of this. The core services ex-housing that is Jay Powell's indicator that he's watching goes the wrong direction, but durable goods prices were up 5.5%, while services prices were up only 0.6%. So at this point, the goods price deflation that we saw has started to level out or go the wrong direction, which is part of the reason we're seeing these higher numbers.
What's housing going to do?
It looks like it's going to stall. We got some disappointing numbers.
And I was reading in the West, it's more than stalling.
Well, today we get new home sales, and that's going to be a little bit more difficult because you've got a lot of rebuilding from hurricanes and fires and snow that we got last year. But we are seeing a deterioration in housing, definitely, as mortgage rates go up.
Okay, Michael McKee, thank you so much with the economic data. Mr. McKee's day will continue, and you have to continue with us on radio and TV. Let me get up the McKee screen, MCKEE Go, and it tells me new home sales are coming up. I'm focused on that more than anything. And then there's, out in Ann Arbor, they're going to come out with some confidence statistics as well that McKee says are somewhat important as well. It has been an extraordinary week. Stay with us on Bloomberg Radio and Bloomberg Television. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
The wrong kind of upside surprise on inflation data in America. Live from New York City this morning. Good morning, good morning. Equities down, yields up on the S&P down by 1.27%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, inflation data delivering another upside surprise. The US targeting Russia with sweeping sanctions as Putin's invasion of Ukraine hits the one-year mark. We begin with the big issue. Good news is hard to find.
Good news is bad news.
Bad news.
Bad news.
Good news, bad news.
We're in that point in markets where good economic news is bad news.
The economy's going to get stronger and the Fed's going to stay tighter.
The Fed's going to have to be a little bit more aggressive.
It's going to be harder for them to stop raising rates. On the other hand,
We do think you'll see moderation.
the economy will start to weaken, and that will hurt corporate profits as well.
There are risks.
Recession risk. The downside risk is higher than the upside risk.
We still have a high inflation environment.
The geopolitics at the moment still looks pretty difficult.
It's going to be pretty painful. There could be more pain to come.
More pain right now in this equity market. Alongside me this morning, I'm really happy to say, Mohammed Al-Aaron of Queen's College, Cambridge, and of course of Gramercy Funds. Mohammed, how about that PCA print from about 30 minutes ago?
Yeah, this is bad news, it's bad news. And it's bad news across the board. It's bad for the economy, it's bad for livelihoods, it's bad for bonds, it's bad for stocks. It is just bad news.
Put it all together for January. Where does it leave this Fed?
Behind yet again, and for the third time in this cycle. I think right now they're going to have a very serious discussion as to not only should they have done 50 last time, which they should they do 50 next? And it's a really tough discussion.
You said going into the last meeting, they needed to go 50. You thought they'd go 25. Chairman Powell in that meeting talked about the disinflationary process beginning. Then we all read the minutes. You counted how many times he said disinflation in the news conference, 11, right?
Right.
Then in the minutes, 0.
Right.
What's going on there?
So, I refer back to what you said yesterday, is the question, can they massage, that's the word you use, massage the minutes to reflect subsequent data? I don't know, maybe Mike McKee can tell us, but the minutes were not consistent with the message of the press release. But I think even this word disinflation can't be said anymore. Inflation is heading the wrong way.
So January data, bad on the inflation front, good on the output front. To see claims where they are, unemployment at 3.4%, wage growth still in and around where it is. We've got payrolls where 517,000, just phenomenal numbers here, Mohammed. Do you think that continues? Do you see signs, evidence that that's durable through the next couple of months?
So we see evidence that the economy is slowing, and that's a real issue because you don't want the Fed to be forced to hike a lot into a slowing economy. So we are seeing evidence that the economy is slowing, but the labor market remains really strong. So it is a very difficult economy to read. I just want to stress, this is a very difficult economy to read. I could sit right here and give you 3 scenarios for growth, 3 scenarios for inflation, and 3 scenarios for monetary policy. Now think of how many interactions you get in this 3+3. This is a really tough environment both to predict and to invest.
Which scenario right now would have the highest probability for you?
Sticky inflation, but it's a 50% probability. It's not an overwhelming probability.
Look at these moves in this bond market. German 2-year, about 3% for the first time since 2008. Big moves at the front end of the curve in the US. Given where things are priced right now, how much upside risk is left around what we're projecting for terminal rates at the ECB and the Federal Reserve? We're talking like 4 at the ECB, maybe 5 pushing 6 now at the Federal Reserve. What's left from that conversation?
Well, 5 pushing 6, 5 and 6, they're very, very different. Let's call it 5. Okay, is it 5, 5.25, 5 3/8? I think that remains the baseline, but the balance of risk is clearly to the upside.
Do you think that gets it done, 550? Do you think they have the tools to get inflation back down towards 2%?
So, John, as you know, I don't think 2% is the right target for this economy. And that's why a longer-term view is important. There's a lot of things going on the supply side that would argue for a slightly higher inflation target. Now, of course, the Fed cannot change its inflation target after missing it for so long. So they have a real problem there. I think the best we can hope for, honestly, is stable inflation at 3 to 4. If they try to get us to 2, the damage to the economy, the damage to livelihoods is going to be severe.
You've taken some heat for those comments in the last week. People are saying, Mohammed, why should we tolerate 3 to 4%? What's your response to them?
Is look at the balance of risk. If you go for 2 and you completely crush the economy, the impact on livelihoods is going to be huge. The last thing we need, John, is for people, especially from low-income backgrounds, to have had their living standards robbed by inflation and then have income insecurity on top of that.
Chairman Powell, Jackson Hole, end of August, he said this: failure to restore price stability would mean far greater pain. Is he wrong?
Right now, he's absolutely correct. Had he moved earlier, had the Fed not mischaracterized inflation as transitory, had the Fed not waited till March of last year for the first rate hike, had the Fed not downshifted so quickly to 25, the pain would be less. But he's right. Right now, unfortunately, if they want to get to 2%, they're going to inflict tremendous pain on this economy.
Least worst option then, except 3. Where does that leave this market if we seriously start talking about a Fed accepting 3 to 4? In reality, do people start doubting their ability to land at 3 to 4?
I think people are already doubting. Look at what's been happening to every inflation indicator. It is heading now the wrong way. The market indicators started heading the wrong way, the break-evens. Now we're seeing actual and survey indicators are heading the wrong way. So I think the market and, more importantly, people in the street are starting to doubt whether the Fed can deliver the 2%.
Equity futures right now down by 1.25% on the S&P 500. Significant moves developing in the bond market off the back of that PCE print from 36 minutes ago. Yields up at the front end by 7 basis points. 477 on a 10-year, up 5 or 6 basis points to 393. Talked a lot about that renewed dollar strength. Euro dollar down every single session on the week so far. Euro dollar 105.50. Negative there, 0.4%. Mike McKee, it's another bad data point for this Federal Reserve.
It is definitely another bad data point. I am in complete agreement with Mohammed El-Arian on that. Here's the numbers. We had seen a 1/10 decline in personal spending during the month of December. That was raised to 1.8%. So people are still out there spending. The economy is still growing. Personal income, 0.3 is now 0.6 higher. That is largely Social Security. I'll get to that in just a moment. A PCE headline, though, there's where our problem is. 0.2, 5.3 has now moved to 0.6, 5.4, and the PCE core goes from 0.4, 4.6 to 0.6, 4.7. So we're seeing inflation rise again. The number that everybody was kind of looking for was the PCE core ex-housing, because Jay Powell's talked about that. It's moving in the wrong direction as well. A 0.6 gain on the month, now 4.61%, an increase in both the month-over-month and year-over-year numbers. So that is also not good. That's where they have been looking for issues. Now, in terms of what's going on with the income side, because of course we're all watching that, it is not good news. Wages and salaries up 0.9%. Social Security payments, we knew there was a big COLA coming. You can see the impact. That's the white chart there, 9% gain during the month. But the interesting thing is the savings rate goes up 4.7%. It may be because of the Social Security payments, people putting extra into their bank accounts during the month. In January, you always have to look a little bit skewed at in terms of incomes, because it's the month you get raises, it's the month COLAs go into effect. But it does seem that we are seeing strength in the economy that is a problem for the Fed. However, I would throw this out there, and I would throw this out there to Mohammed as well. At his last press conference, Jay Powell said people like Mohamed El-Arian have a different job than I do. They're reacting to every data point every day, whereas we are meeting once every 3 months. And we don't know what February numbers are going to be like. Powell said at his news conference, and other Fed officials have reiterated, that they expected inflation to rise again, that there would be bumps along the way. And so it may be that you want to trade on today's numbers, but in terms of setting up for the Fed, we've still got 3 weeks to go.
So, Mike, continue on that theme, and in particular, there's the question, is the Fed not too little data dependent because they don't look at it every day, like you said, and they only have periodic chances to move? Is the Fed too data dependent? One of the things that I find surprising these days is that it's not clear what the longer-term analytical anchor for the Fed is anymore. So how do they combine being data dependent, which they repeat over and over again, with formulating some sort of longer term analytical anchor?
Well, it is really difficult because the models are broken, and the analytical anchor that they had switched to of inflation not likely to go higher, so we'll let it run above 2% for a while, doesn't fit either. They are going to watch the inflation numbers more than anything else because that's what they've said is going to be the target, the idea. They're going to bring down inflation to 2%. They're not saying how long it's going to take. They don't want to crash the economy, but they're going to keep the pressure on. Now, how much they have to do more, we'll see when they come up with the new SEP on March 22nd. That's always one of the issues, is the Fed's going to always be behind in terms of its projections because the market changes its view every day, and the Fed only changes once every 3 months when they put out the new dot plot.
You've got to get to March 10th first as well, the next payrolls report. Mike McKee, thanks for that. Mohammed, you and I had a conversation earlier this week. We talked about the Fed being data dependent, and I asked, how dependable is the data? Torsten Slock of Apollo wrote this morning, and others have written about this and talked about it. We've written about it. Steve Englander of Standard Chartered talked to us about it in the past week. Said response rates to both labour market surveys and inflation surveys are declining. We're all aware of that. Torsten Slock of Apollo said this morning the economic data is becoming more unreliable. Would you agree with that?
I don't know if I would, John, because we're having pretty consistent economic data from different indicators. So I wouldn't go all the way to say the data is unreliable. I think the insight here, which is absolutely critical, is data dependency is necessary but far from sufficient. You've got to have a longer-term view. You know my view. The supply side is fundamentally changing. It's changing because of geopolitics. It's changing because of companies stressing not just efficiency but resilience. It's changing because of the functioning of the labor market. And it's also changing because of what's happening to globalization. So if you are underpinned by an analytical view that says it's the supply side you've got to focus on, you become much more aggressive in dealing with inflation up front.
Do you think this Fed is underpinned by that analytical view?
I think you just heard it from Mike. They don't have a longer-term analytical view. The framework they have is out of date. It's for the economy of 2010 to 2020. It is not for the economy of today, and I don't believe it's for the economy of tomorrow.
You're going to stick with us through the hour. It's not about what we think the Fed should or shouldn't do at the next meeting. What do you think they will do?
I suspect they'll do 25, but there'll be a very robust discussion about doing 50.
And in the projections in the SCP, you see that terminal rate coming up?
Unless the jobs report surprises in a huge way to the downside, they're going to have to revise up that dots.
March 10th for that payrolls report. Looking forward to it. Equity futures right now on the S&P down by 1.3%. We are facing an opening bell about 17 or 18 minutes away. Coming up next, the BOJ looking to stay the course.
Investors are starting to take a look around and say, all right, we got global yields rising. The BOJ is probably not going to normalize policy further in the very near term. It's hard to wrap your head around, John.
That conversation up next with MUFG's George Goncalves and Kirsten Distenfeld of AllianceBernstein from New York. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
We got global yields rising. The BOJ is probably not going to normalize policy further in the very near term. It's hard to wrap your head around, John, and certainly when you look at the spot inflation picture and where wages have been trending. Once people start talking about inflation, that actually can change the paradigm a little bit. So I wonder if the same dynamics take hold in Japan.
Lower for longer. Bank of Japan Governor, the nominee, Kazuo Ueda, vowing to continue easing at his confirmation hearing, saying the following: "If I'm appointed, my mission isn't to come up with some kind of magical special monetary policy." We all wish we had that. There are improvements in price trends, but it would still take some time until we've securely achieved 2% inflation. This is Japanese inflation. It's a fresh 4-decade high. Mohammed back with us. Mohammed, just a quick comment on this. The ECB pushing towards 4. It's what we're pricing now in markets. The Federal Reserve, a discussion has come about in the last couple of weeks about maybe hitting 6. Where are these guys? Where's the BOJ?
So the BOJ is stuck in this yield curve control regime. It's going to have to exit. The market is telling it it's really costly staying there. You've seen the 10-year stuck at 50 basis points. They're having to buy a lot of bonds. I think the nominee was absolutely correct in being cautious. That's what he was, and sticking to the script. But once he gets into the building, he's going to have some really hard thinking to do.
There's going to be some big questions. March 10th as well, not just payrolls, but also the last meeting for Governor Kuroda at the Bank of Japan. For us, we're about 14 minutes away from the opening bell, looking at equities down by about 1.3% off the back of another hot inflation print in America. To discuss alongside Mohammed, MUFG's George Goncalves, Gershon Distenfeld of AllianceBernstein. Gershon, first to you. Your response to that data from 50 minutes or so ago.
Well, it's another piece of data that's going to move the Fed to stay higher for longer. I continue to think that, even I know it's what the market's going to focus on, when the terminal rate is 5 3/8, 5.5, even 6, is just not nearly as important as how restrictive the Fed is going to be in the long term. In other words, the time frame from the last hike to the first cut, which the market is still assuming is going to be later this year. This just makes it much, much more likely that they're going to stay the course. They're going to keep rates high for a long period of time, into 24, perhaps longer. And that certainly has implications for growth in the economy.
George, what's your take?
Look, I think, John, as we mentioned last time I was on the show in late January, we have to be careful not to extrapolate. We've had some really favorable data, better weather, and we've seen improvements. And of course, inflation is proving to be sticky, but it's been consistent with what we've gotten all throughout the month. And this has been a tough month for the bond market. 70 bips move in 5-year and 10-year rates. I think a lot is priced in at this point, but at the same time, if we don't see a kind of move lower in March, April, May, which should happen given the base effects on inflation from last year, then I think, we have a bigger problem on our hands in the bond market.
George, credit where it's due. You said this before, Larry Summers. You said a real no landing might actually be a Wile E. Coyote moment instead. What do you mean by that?
Well, the idea is that, if you have we're now at this point where we believe that we're going to have a recovery from this point with really high rates and still sticky inflation. And in fact, that just further encourages the Fed to stay on hold for even longer, maybe even go higher in rates, which almost ensures at least a bumpy landing, soft landing, maybe even a hard landing later in the year into 2024. So this idea that we're kind of suspended in air, as Wile E. Coyote and those cartoons would show us, I mean, it only can stay there that long.
Gershon, I want to go back to the higher for longer and why it is that the market doesn't buy the higher for long. There's two arguments. One is that the cumulative impact of rates is going to be too much for this economy. This economy is going to slow down really, really quickly, and therefore the Fed is going to have to cut. That's camp A. Camp B says the Fed is going to have to cut because inflation is going to come down really quickly. So how do you reconcile those two views, and tell me what you think higher for longer actually means in terms of how high and how long?
Yes, Mohammed, I think you hit the nail on the head. It makes a huge difference which of those two scenarios is right. If the market is just saying, we don't believe the Fed, we think the Fed's eventually going to see data weaken, the labor market weaken, negative growth, and they're just going to have to cut. They think they're going to stay the course, but they're not going to do that. That's one view of the world, as you articulated. The other view is that they're going to cut. They're going to end up cutting. Going to have to cut much faster. The inflation's going to come down a lot more, and that's going to do it. The difference between those two views is whether we're going to see a lot more volatility when the data actually comes out. If the market believes that, if there's this disconnect, and the market just doesn't believe the Fed, then every time we get a piece of data, good or bad, we're going to swing a lot. If it's just a difference in market expectations of where inflation is going to come out, then that'll resolve itself over time, and we'll have a much smoother, market path to risk assets.
Gershon, let's talk about credit as well. Let's talk about taking risks. So we came into this year and there was a big call from a lot of people that basically we'd see that equity bonds correlation break down. Here we are on another morning with bonds down, yields up, and equities down as well. When you're thinking about those correlations, how does high yield factor into that, Gershon?
High yield, is a risk asset and is going to perform in line with equities. The correlation between high yield and equities actually has been pretty stable. But there's no question we're in this good news is bad news type environment, and bad news is good news. And for that, we're going to keep on seeing a positive correlation between rates and stocks, which we usually don't see. I think it's really, really important that we pay attention when that changes, because that is a signal that actually things are returning back to normal. We're in a very abnormal situation right now, caused for a lot of reasons. As I think Mohammed alluded to earlier, the supply side is becoming much more important to the inflation picture than the demand side. So we have to pay attention. And as long as we're in this kind of funky environment where stocks and bonds and risk-free bonds do the same thing, we're going to have to be very, very wary about what future data is going to tell us and how that's going to affect volatility in markets.
George, any reason for that correlation to break anytime soon?
Look, I do think that the traditional measures that we've all looked at in the past as bank lending standards have gotten tighter, the fact that we've had a big move in all-in yield for high yield is like 8-9%, that kind of gives you this optics that they've already discounted a lot of the sort of credit concerns. But as we all know, the majority of that move has been mostly rates. And so I am kind of concerned about high yield in the second half of the year as the economy does most likely slow down to our forecasts. And then you actually start to get, credit concerns filtering into the credit space, and it's going to hit high yield first before everywhere else. And so I think that the correlations, in sense, at some point they do flip, and then it does become favorable for treasuries, but that's more of a trade for at the end of the year. And this is something I've mentioned with you in the past. It's hard to have these kind of opposing views where in the short run, you've got to respect the Fed and let's see how high rates can go. But ultimately, the more they do that, it's going to cause pain in other markets.
Gershon, I've got 30 seconds left. I just wanted to give you the final word on high yield. Where are you now?
Well, I think we are more cautious, and we would be more up in quality. Be careful about dipping down to triple C's. We still think that, all-in yields of 8.5%, there's a lot of demand, particularly outside the U.S. The technicals are going to be very good, and that's going to balance things. But ultimately, we do expect pretty low losses. So we think high yield returns will be pretty good over the next couple of years, but certainly in the short term, we think that there is a cap on how much spreads can tighten further.
What a move this morning. Gershon, George, to the both of you, thank you. Yields up by 9 basis points at the front end on a 2-year, 4.78, pushing 4.80. Mohammed's going to stick with us. Coming up, the morning calls, and later, BlackRock's Kate Moore starting to see some opportunities in big tech.
reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
Equities down hard. We're down by 1.4%. Let's get you some morning calls. First up, Morgan Stanley raising its JP Morgan price target, saying the bank's market value could hit $1 trillion in a soft landing scenario. Barclays initiating coverage on MGM Resorts with an overweight rating, expecting shares to benefit from the recovery in Macau. That stock is negative 1%. And finally, SVP Securities downgrading Moderna to underperform with a street low $93 price target, forecasting a major breakdown in margins as the pandemic boom reverses. That stock's negative 4%. Up next, BlackRock's Kate Moore.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
22 seconds away from the opening bow this morning. Good morning. Not much of a good morning if you're long this market. We're negative 1.3% on the S&P. Futures negative on the Nasdaq 100, down by 1.76% on the S&P this week, heading towards a third week of losses on the S&P 500. Longest weekly losing streak of this year so far. There's your opening bow. Switch on the board and get to the bond market. Post PCE. Upside surprise coming in hot. Inflation in America, you know the story. Yields up 7 basis points, 3.94.91 on a 10-year, and coming really, really close to 4.80 on a 2-year. Yields higher at the front end of the curve by 10 basis points. Bit of dollar strength out there. Euro dollar 105.42. Euro dollar negative 0.5%. Keep an eye on crude 74.62. Down about 1% there. About 20 seconds into the session, equities down as you might expect. Following that data out about an hour ago, on the S&P 500, we're down by 1.2%. On the Nasdaq, we're down by 1.6%. Mohammed, great to have you with us to work through some of this. What a move in the bond market to see the 2-year so close to 480. Subhadra Rajappa was on the show with us earlier this morning with Tom and myself from SocGen. She said there was asymmetric risk around the bond market. There's more downside than upside to yields. Do you agree with that?
I think we're getting more balance, actually, John. I mean, we've moved a huge deal. 4 or 5 weeks ago, people were talking about going through 4%. We got to 4.02, 4.03. Yeah. So we've moved a huge way. So I'm not sure. I think it's more balanced now than it's been before. The one thing I don't know, and that's worth you pursuing, is what's going to happen to flows. We opened the year with the consensus that you want to be in bonds. People went into bonds. We had a lovely rally. It went too far, too quickly. Now we've pulled back. The question is, will people put more money to work, or will people worry that bonds are not risk mitigators? And that I don't know. So it's really important to get the technical call right at this point.
Well, there's a lot to unpack there. You and I went back and forth on this a little bit earlier this week. And I was basically asking you whether you think this is a once-in-a-generation opportunity to lock in yield for as long as you can, or a new generation of higher yields. Which one is it?
And what did I tell you? I said, I don't know, John. I've never seen such uncertainty about growth, inflation, and policy. I've never seen this before.
So for you personally, do you take a 6-month of 5%, 2-year?
So for me personally, I'm still very barbelled. I do take interest rate risk higher up in the quality spectrum, and I take it not just short term, but longer term too. But then I look for bottom-up name selection where the mistake is recoverable. I think people don't ask the question enough, are mistakes recoverable in this environment? Default is not a recoverable mistake. Many other investment mistakes are recoverable. So you've really got to build your portfolio from bottom up, not top down.
Can we talk about reinvestment risk just briefly? If you took a 6-month of 5% and then found yourself in 6 months looking at fixed income, have you got any idea what that might look like in 6 months' time? Just how big is that reinvestment risk around that story?
I don't, and that's why I'm not taking it just in 6 months. That's why I'm spreading it along. I think, as I said earlier, I can sit right here and give you 3 plausible scenarios, and I cannot tell you with a high degree of confidence which one you should bet on. That's unusual.
That's where we are right now. Yields up 10 basis points, really, really close to 480 on a 2-year. Your equity market's down and down hard, up 10 basis points at the front end of the curve. One stock to watch at the open, Boeing, pausing deliveries of its 787 Dreamliner due to a documentation issue. The company's saying this: while near-term deliveries will be impacted, at this time we don't anticipate a change to our production and delivery outlook for the year. Abby has more. Hey, Abby.
Hey, John. Well, the stock is certainly down hard, heading to its worst day of the year since December. At one point at session lows, down almost 5%. At that point, on pace for the worst day since October. So there is definite bad news here, even though analysts are saying that it could be short-term along with the company. But essentially, they are halting their 787 Dreamliner deliveries on a fuselage part review. The problem stems from an analysis error by a supplier related to the 787's forward pressure bulkhead. Now, Boeing discovered this issue in certification paperwork provided to the FAA and then notified the regulator. But to your point, or to the company's point, I should say, it seems as though the Dreamliner production is going to be continuing as Boeing works to resolve the issue. They're also saying that it does not pose a quote-unquote immediate safety of flight concern for the in-service fleet, so that's definitely a relief to many. Boeing expects no change to its 2023 production delivery targets for the plane, only affecting the near term. That's important because what we're looking at here in white is the revenue coming off of multi-year highs Meanwhile, the stock, even though it's down today, up solidly on the year, so probably investors hoping that it's not going to affect it all that much, but we certainly have other related airplane companies and airplane supplier companies down sharply. Spirit, they're a supplier, GE, Raytheon, so we have some weakness here, and again, Boeing under pressure itself, down more than 3%. Worst day of the year, John.
Abby, thanks for that. Looking at a 2-year, flying high. 480 is the high of the session now, 480.73, right now just short of that number. Remarkable moves in this bond market, popping after a big move in PCE for the first month of 2023. From planes to automobiles, Carvana under pressure after reporting a bigger than expected quarterly loss. The CEO saying this: rising interest rates and market sentiment drove a significant shift in our priorities away from growth, leading to markedly lower volumes. As a result, we've been carrying excess costs. Ed Ludlow on the West Coast with more. Hey, Ed.
Yeah, good morning, Jonathan. The stock down more than 12%. Only the biggest drop in a week, but a decline of more than 16% would be our biggest drop on Carvana going back to December. A loss of $7.61 per share was triple, more than triple, what the street was expecting. A sharp decline in retail sales and the profits accompanying in the quarter spells more of the same to come. You see the numbers from the quarter there, and on the top line as well, $2.84 billion, also a miss and a big drop from this period last year. Analysts are talking about liquidity risk, and a big reason is the $8 billion of debt that Carvana carries and needs to service, right, John? A big part of this story is that $5 billion of it is in distressed territory, that most of it is rated CCC, and how are they going to service that? The CEO talking on the earnings call kind of said that he saw a path forward without needing to raise additional capital, and in the marketplace, that certainly raised a few eyebrows, but the street's reaction as a whole, John, is one of concern around liquidity and what this company does going forward. It's also a story of mismanagement. That chart for me is pretty astonishing, down 98% in 2022. The shares have rebounded at the start of this year, but a really interesting comment from our colleagues at Bloomberg Intelligence: go back and look at Hertz before the bankruptcy and what those shares did in the weeks. A similarly prolonged dead cat bounce, and that's got people really worried. Don't focus on the recent near-term performance of this stock. Look at the debt pile, and that's where the street's focused this morning.
Stock's getting hammered, down 13%. Ed, thanks for that. Elsewhere, an antitrust suit hitting shares of Adobe. The Justice Department preparing a lawsuit to block the firm's acquisition of Figma. Analysts at MoffettNathanson say if the deal is blocked, it would be a material negative for growth. More on the story with Katie. Hey, Katie.
Hey, John. Well, Bloomberg is reporting that the DOJ could file that suit as soon as next month. And of course, the logic behind Adobe buying Figma in the first place is that it would give Adobe a foothold with small businesses and everyday users. It would be one of the largest takeovers of a private software company, reportedly, that has the DOJ concerned. And Adobe shares, they're falling right now, down about 6%. Though short term, this could be a positive. Remember, when this deal was announced back in September, that $20 billion price tag, it did sink Adobe shares, but as you mentioned, MoffettNathanson and some others coming out and saying this is key to Adobe's growth. If it doesn't go through, this could definitely put Adobe at a competitive disadvantage. And that has sector-wide implications, John. Of course, software is up on the year, but compared with other types of tech, such as chips, such as hardware, it's definitely the underperformer, and today's price action in Adobe doesn't help.
Down 6%. Katie, thanks for that. Your broader equity market down more than 1%. If you are just tuning in, about an hour ago, we had more inflation data out of America. It came in hotter than expected. The inevitable happened. Equities dropped. Bonds dropped with it. Yields popped. At the front end on a 2-year, we breached 480 for the first time, going all the way back to 2007. Joining us now, BlackRock's Kate Moore, seeing some silver linings in parts of tech and writing the following: we are not adding to overall equity risk, although we continue to rotate sector exposures in favorable of sustainable quality growth. After a meaningful valuation adjustment in 22, parts of tech look to fit our quality growth criteria, and we have been encouraged by solid earnings and guidance in parts of software. Kate, great to have you with us. We can talk about the tech theme in just a moment, but hot inflation, resilient growth, high nominal GDP world, where do you want to be in this equity market?
John, I think we've talked about this a couple times since the start of the year, and my inclination is always to want to look for stuff to buy and to add risk. But frankly, I think there's too much that we need to get through before we can really do that. We've been keeping our overall equity beta pretty stable, and we've, as I said before in those kind of notes, rotated some of our exposures underneath the surface. And here's the thing. There are companies that have come out of this earnings season with strong messages. They have talked to us about their cost control. They've streamlined their businesses. They have adjusted well to a higher policy rate environment, and frankly have pretty good revenue growth prospects over the course of this year, even in a slowing economic environment. And for especially some of the tech stuff, we saw multiple derating throughout all of 2022, pretty sharp and furious. And some of these companies actually look pretty good. So we're rotating a little bit more into some of those names. But in general, we think inflation is going to come in a little hotter. We saw that obviously this morning. Over the next couple months, that's going to be a headwind to equity market sentiment. And the Fed is going to continue its path of policy rate adjustment and hiking for the next 3 meetings. So, you know, we're not in a place where we want to say we go all in, that the worst is behind us in terms of policy rate risk. And at this point, we're just picking our battles.
Okay, I want to talk about discretionary as well. John Golub of Credit Suisse was on yesterday, and he said this is perfect for consumer discretionary. Discretionary year to date has been absolutely flagged. That's where the leadership has been, besides from the big rallies we've seen elsewhere in tech. What's your view on that now?
Yeah, there's some really, strong pockets in the consumer sectors, and I think that's a great observation from Jonathan. What I would note, though, is that it is not a one-size-fits-all or a one-experience-fits-all of consumer. There have been some notable companies that have done a great job of what I was talking about a moment ago, cutting costs, managing their labor expenses, kind of streamlining their businesses to upweight those parts of their businesses that will do well in a slowing economic environment, even as income growth remains pretty strong. And of course, we saw that data this morning. But it is, I think, a place where you want to pick your individual stories instead of buying the whole sector, because we're not talking about a re-accelerating U.S. economy or the start of a new and significant expansion. We all know that we have not just policy rate, but otherwise, growth concerns over the course of 2023. And so this is not a free-for-all, John.
Kate, on tech, I was very intrigued by a phrase in the Carvana press release, quote, away from growth. To what extent would you generalize away from growth to the whole tech sector? And if you do, is this a situation where most companies come back leaner and stronger? Or is this a situation where we see massive differentiation?
Yeah, I think it's a great question. One of the things that we've observed across software companies, not just the derating we talked about a little bit before over the course of 2022, was that there was a decent amount of over-hiring across tech and in software and parts of semis. And we've seen those companies get out ahead of the market in terms of announcing layoffs. So that's been really productive. At the same time, while sales cycles have extended for parts of software, and there have been some concerns around overcapacity in parts of semis, a lot of that is working itself out over the last quarter and into the next 2 quarters. And so I expect these companies are going to weather this economic and policy storm pretty well. What I've been really encouraged with is how honest the guidance was during reporting fourth quarter. You didn't get a lot of companies kind of sugarcoating the experience and really speaking to investors in a way that encouraged them that they were going to continue to trim costs on the margins. They were going to focus on smart growth, not growth at any cost. And I think that has really built up more positive sentiment in the sector.
Okay, just great as always. Brilliant to catch up. Kate Moore there of BlackRock. Mohammed always asking better questions than me, which is why we only do this every quarter and just the one time. Talk about sugarcoating gear. This from the president just moments ago. The PCE report shows progress, more work needed on inflation. I'm going to put you on the spot now. Does the PCE report show progress?
It shows hesitant progress. I think the key issue is more work is needed. And this is not just a Fed issue. This is a whole of government issue.
It's a market issue right now. Equity's down by 1.3%. Do you want to do the tease?
I do. Coming up, 1 year of war in Ukraine.
We should never forget that the main source of this uncertainty is exactly the Russian invasion.
That conversation coming up next.
top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
News breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
We should never forget that the main source of this uncertainty is exactly the Russian invasion. And we are not saying this only because it's 1 year today, but because this invasion increased all the fragilities of the global economy.
1 year on, the US slapping fresh sanctions and tariffs on Russia. The Treasury Department writing the following: today's action further isolates Russia from the international economy and hinders its ability to obtain the capital, materials, technology and support that sustain its war against Ukraine. This coming as Ukrainian allies quickly dismiss a China ceasefire proposal. Your team coverage begins right now with AMH in London, Maria Tadeo on the ground in Kyiv. Maria, let's get to it. What's topping the agenda today?
Well, Jonathan, today obviously is a very symbolic day for Ukrainians. We talk about this 1 year mark for them. What they say is this is the one step closer to victory. And that's the thing that just comes up time and time and again when you talk to Ukrainian officials, but not just the people here. You ask them, do you sincerely believe you're going to win this war? And every Ukrainian that we've spoken with over the past 24 hours, especially coming on that train back to Kyiv from Poland, they all say yes, they have this almost blind faith that they are going to win this war. Now, this morning we heard from the Ukrainian President Volodymyr Zelensky. He was giving out medals to soldiers, reminding everyone in the country that there is a sense almost of safety when you look at a city like Kyiv is so protected. When you look at the west of Ukraine, we haven't seen any major attacks, but reminding everyone that the war is still ongoing, and really the situation in the east of the country is also very fragile. We're also expecting, by the way, to see or hear again from the Ukrainian president in a press conference that he's about to give to the international media. But the message overall from the people of Ukraine, in particular, just the people, the resilience they have, is this is one step closer to victory. Ukraine is still standing, and it has defied the expectations of many out there.
Anne-Marie, we've got to talk about as well China. The ceasefire proposal, we can discuss the sanctions from the United States, but they haven't made a heck of a lot of difference over the last 12 months. Walk me through what's been presented by China and the threat of China becoming involved in this war in a more direct way.
So first on this proposal, this proposition paper, Jonathan, which everyone in the West, whether or not it's a European leader in Berlin or it's Jake Sullivan last night, they basically disregarded this. And they're saying that China doesn't have a leg to stand on when they're talking about this because they haven't come out and condemned the war. And while they've engaged with the leadership in Moscow, they have not even spoken to President Zelensky. Xi Jinping has not given him a call. So they say that they are not a player that is fair and balanced when they would want to direct some sort of ceasefire proposal. But what it goes through is similar gripes we've heard from China about protecting sovereignty. One thing that is notable, and you mentioned those sanctions, fresh sanctions coming from Washington and European capitals today, Beijing is saying that those sanctions should not be enacted. They are giving basically an olive branch to try to help Moscow in terms of its economy. They also mentioned other things about nuclear, wanting to make sure that there is no nuclear attacks. This could be viewed on two fronts. One, that China doesn't want to see any sort of intercontinental ballistic missiles being used on the Russian side. But also remember, China was pushing disinformation that Russia was pushing out about the United States using chemical and biochemical weapons in Ukraine. So you really need to read this with a huge grain of salt when it comes to what China is doing. And on your second point, China potentially becoming more involved in the war, we've obviously heard from Secretary of State Antony Blinken talking about non-lethal material Beijing is providing to Moscow. But now they are concerned that Moscow will go over what the U.S. has stated as a red line, which is providing lethal material to Putin. And Der Spiegel had it last night. There's consideration for a Chinese company, which would have ties to the Chinese Communist Party, about sending about 100 drones to Russia.
And Marie, the U.S. sanctions have had some impact on Russia, but not as much as what people expected. What is stopping the U.S. from outpacing Europe and really front-loading even more whatever sanctions remain?
It's a great question, and it's difficult right now for the West, especially the United States. When you look at one aspect of the deluge of sanctions they've had on Russia, what you will hear time and time again from U.S. officials is that they want to enact the most pain on Moscow, but at the same time protect their own economies. And this is particularly prevalent today. We are marking 1 year of a war, and you see the weariness and fragility of Poles, whether it's Europe or America, that potentially there are concerns that these leaders will not have the political backing to continue sending material support to Ukraine. So they want to make sure that they are still protecting their own economies, not to mention the most vulnerable economies in the world, you know, Latin America, Africa, countries in the Middle East that are really struggling with things like food insecurity and energy security.
Anne-Marie, appreciate it, as always. AMH in London, Maria Tadeo in Ukraine, Mohammed Alarin alongside us. Mohammed, that does it for us. That was great.
Thanks for having me.
As always, should we leave it on a final word? What's your final word going through the next couple of weeks? What are you looking for?
I'm just going to say thank you. That's my final word.
That's your final word. No 50 basis point hike from the Federal Reserve, sticking to 25?
I think they'll do 25.
I think a lot of people on board with that view. The pressure to go 50, though, will ramp up even higher if we get a hot payrolls report in a couple of Fridays' time. This Friday, we're lower by 1.5% on the S&P 500, and yields are a whole lot higher at the front end, through 480 on a 2-year. Your trading diary up next.
Our conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Session already, 26 minutes in, we're down 1.5%. Let's see if this sticks through the session. We're down by 1.9% on the NASDAQ. The why, you know the why. An hour and 25 minutes ago, inflation data in America coming in hot, and this happening in the bond market. Yields up big time on a 2-year, through 480 briefly, up at the front end by 10 basis points, up 6 on a 10-year, 393.93. That's the price action. Here's the trading diary. Coming up shortly, new Mitch sentiment survey, top of the hour. Host of Fed Speak, Jefferson, Mester, Bullard, Collins, Waller, all on deck. Chicago Fed President Austin Goolsbee speaking on Tuesday. ISM manufacturing on Wednesday. Another round of jobless claims on Thursday. And President Biden and German Chancellor Olaf Scholz meeting at the White House to round out the week next Friday. That is it for me. Enjoy your weekend from New York. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000. Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.